Most people who start dividend investing spend the first year picking the wrong fund in the wrong account for the wrong goal. They don't know it yet. The portfolio looks fine on the screen, the numbers go up. But 3 years in, when they finally sit down and run the math, the gap between what they have and what they could have had is the kind of number that's hard to look at. That gap is what this compilation is all about. In this compilation, I've put together everything I've covered on dividend ETF investing this year. We start at the absolute beginning, what an ETF actually is, and how to start with $5,000. We then build the 3-fund portfolio I would actually run in 2026 and show you how it turns $10 a day into $1 million portfolio. From there, the comparison gets even bigger. We put $100,000 into Fidelity and $100,000 into Schwab across 5 rounds. Fees, S&P 500, total market, bonds, and international. And the gap between these two providers ends up over $1.5 million. You'll see how $20 a week turns into $4,800 a month in dividend income. How a faster path gets you to $4,000 a month 20 years earlier. How a Roth IRA changes the math on every dollar you keep. And how $1 million doubles in 2 years. And in the end, you'll see how someone starting from $0 reaches retirement on Fidelity index funds in 10 years, and exactly what that takes. Whether you've got $5,000 sitting in a savings account, $100,000 you're not sure what to do with, or you're starting from zero and just figuring out that first move, there's a section in here built for who you are. Let's start at the beginning. If you've ever had money sitting in a savings account and thought, I should probably be doing something with this video is for you. Maybe you've asked yourself, is $5,000 even enough to start? Do I need more before it's even worth it? What if I invest and the market crashes tomorrow? What if I pick the wrong ETF and lose everything? What if I'm already too late? In this video, I'm going to answer every single one of these questions, step by step, starting from zero. What exactly are ETFs? How do you choose the right ones? How can you build a real portfolio with $5,000? And exactly how do you buy it today? In the end, I'll show you 2 things. 1, how John turns $5,000 into a $250,000 portfolio with 3 ETFs and no additional contributions. And 2, a bonus portfolio where 2 changes to that same portfolio turn the exact same $5,000 into a portfolio worth over $600,000. But before we build anything, John needs to understand what he's actually buying. Because most people who've heard the word ETF couldn't explain it in one sentence. And that's not their fault. The financial industry has a habit of making simple things sound very complicated. So let's fix that right now. An ETF, short for exchange traded fund, is basically a basket. That's it. Instead of buying one company and hoping it works out, an ETF lets you own hundreds or even thousands of companies all at once. One purchase, instant diversification. If one company inside the basket has a bad year, the rest carry it. Now, how is that different from a stock or a mutual fund? Well, a stock is ownership in a single company. If you buy Apple stock and Apple has a terrible year, you feel every bit of it. The upside is higher if you pick right. The downside is just as steep if you don't pick right. Look, most people don't pick right consistently, and the ones who do get lucky more often than they'd like to admit. Now, a mutual fund is also a basket, but someone is managing it for you. A fund manager is making decisions about what goes in and what comes out. That sounds helpful until you see the fee. Actively managed mutual funds typically charge 0.5 to 1.5% per year taken out of your investment, whether the fund goes up or down. Over 30 years, that fee becomes one of the most expensive things in John's financial life. An ETF splits the difference. It's a basket like a mutual fund, but nobody's managing it. It just tracks an index, the S&P 500, the NASDAQ, the global market. Whatever the index does, the ETF does. No guesswork, no manager making calls with John's money, and the cost reflects that. The ETFs charge between 0.03 and 0.3% per year, a fraction of what a mutual fund takes. And that one number, the expense ratio, is the most important thing John checks before buying any ETF. It's the percentage taken out of his investment every single year regardless of performance. A fund charging 1% a year takes $10 out of every $1,000 John has every year, whether the market goes up or down. Every ETF in this video has an expense ratio under 0.2%. It's the first thing John looks for, and it's the first filter we're going to use to build his portfolio. So, expense ratio is filter 1. But there are two things John checks before putting a single dollar in, and they're just as important. The second thing John looks at is what the ETF actually tracks. Two ETFs can both call themselves index funds and own completely different things. One might own 500 companies, another might own 8,000. One might concentrate entirely in technology, another might spread across every sector in the global economy. The label doesn't tell you what's inside, the index does. So before buying anything, John asks one question about every ETF he considers. What does this actually own? Not the marketing description, not the fund name, the underlying index. And what's in it? If you don't know what an ETF tracks, you don't know what you're buying, and you won't know why it's going up or down when it moves. That matters most when the market drops, and John needs to decide whether to hold or panic. Knowing what's inside the fund is what keeps him from making the wrong call at the wrong moment. The third thing John looks at is track record, not past performance as a guarantee of future results. Every fund disclosure in the world will tell you that, but consistency over 10 to 20 years as a signal of stability. A fund that has been through the dot-com crash, the 2008 financial crisis, the 2020 pandemic, and recovered from all of them is telling John something. It's telling him the index it tracks has survived real market cycles, that the companies inside it have proven they can come back, that the structure of the fund itself is tested and trusted. John isn't looking for the ETF that performed best last year. He's looking for the one that has shown up consistently over decades, because that's the timeline he's actually investing in. So there are three filters. 1, expense ratio under 0.2%. 2, know what it tracks. And 3, proven track record across multiple market cycles. Every ETF in the starter portfolio clears all three. Here's how John builds it and the reason behind every decision he makes. This starter profile is built around 3 ETFs, each one chosen deliberately, each one with a specific job inside the portfolio. Before we get to how John splits his $5,000 across the 3 ETFs, let's talk about what each fund actually is and why it belongs here. The first fund is VOO, the Vanguard S&P 500 ETF. VOO tracks the S&P 500, which is an index of 500 of the largest publicly traded companies in the United States. Apple, Microsoft, Nvidia, Amazon, Berkshire Hathaway, and 495 others. When John buys VOO, he owns a piece of all of them simultaneously. Not a bet on one single company, ownership of the American economy's largest and most established businesses in one place. The index is weighted by market capitalization. This means larger companies make up a bigger share of the fund. So when the biggest companies grow, John's VOO grows with them. On the other hand, when a smaller company in the index struggles, it has less of an impact on John's portfolio because it represents a tiny fraction of the total. Expense ratio is at 0.03%, the cheapest fund in this entire video. Average annual share price appreciation, 13.17%. VOO passes all three filters without hesitation: the lowest cost, the most trusted index in the world, and a track record that survived the dot-com crash, the 2008 financial crisis, and the 2020 pandemic, recovering from every single one. VOO's job in this portfolio is stability. It's the foundation that everything else is built on. The second fund is QQQ, the Invesco NASDAQ 100 ETF. QQQ tracks the NASDAQ 100, the 100 largest non-financial companies listed on the NASDAQ exchange. Technology dominates here. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla sit at the top. Technology makes up over 50% of the fund. Consumer discretionary and communication services fill in the rest. The expense ratio is under 0.2%. The average annual share price appreciation sits at 19.13%. The difference between QQQ and VOO is concentration. The S&P 500 spreads across 500 companies in every sector: financials, healthcare, energy, utilities, technology. The NASDAQ 100 concentrates in innovation-driven companies. And that concentration is why QQQ has historically outperformed the S&P 500 over long time periods, and why it also falls harder when technology has a bad year. John isn't buying QQQ for income. He's buying it because he wants more than what the S&P 500 alone delivers. QQQ's job in this portfolio is acceleration. VOO is the floor. QQQ is what pushes the ceiling higher. The third fund is VXUS, the Vanguard Total International Stock ETF. VXUS tracks over 8,000 companies across developed and emerging markets outside the United States, Europe, Japan, the United Kingdom, China, India, Brazil, every major economy except America in a single ETF. Expense ratio, 0.05%. Average annual share price appreciation, 6.56%. Dividend yield, 2.86%, the highest in this portfolio. So international stocks don't always move in the same direction as U.S. stocks. When U.S. markets struggle, and they will, in cycles, international markets sometimes hold steady or grow independently. That's geographic diversification. John's portfolio isn't entirely dependent on the United States having a good decade, and over the long run, there will almost certainly be stretches where it doesn't. The appreciation rate is the lowest of the three funds. VXUS is not the growth engine. Its job is balance. At a small allocation, it won't drag the overall return, but it provides something neither VOO or QQQ can, and that is the rest of the world at almost no cost. The U.S. market has led the world for the past decade. It won't always. VXUS makes sure John is covered either way. 3 funds, 3 jobs. And here's how John splits his $5,000 across them. Half goes into VOO, $2,500, because that's where the stability lives. The other 2 funds can take more risk because this one doesn't have to. QQQ gets 30%, $1,500, enough to meaningfully push the long-term return above what VOO alone delivers without making the whole portfolio rise and fall with the NASDAQ every quarter. And VXUS gets the remaining 20%, $1,000. And it's not a token allocation, it's a real position that adds geographic balance without diluting the growth story that VOO and QQQ are building together. John's total investment is $5,000. One time, nothing added after day one. Across the 3 funds, the portfolio blends out to a 1.27% dividend yield, a 7.24% dividend growth rate, and an average annual share price appreciation of 13.64%. That's the number that does the heavy lifting over 30 years. In a couple of minutes, I'm going to show you how John's starter portfolio could grow to over a $250,000 portfolio valuation from his original $5,000. Then I'll show you a bonus portfolio where 2 changes to that same portfolio turn the exact same $5,000 into a portfolio worth over $600,000. But first, let's discuss what to do once you've selected the ETFs for your portfolio. So John has his portfolio. Now he needs to know how to actually buy it. This is the part most investing videos skip. They tell you what to buy and never actually show you how. So let's fix that right now, because the actual process of buying an ETF is simpler than most people expect. Just 3 steps. That's it. The first step is opening a brokerage account. This is where John's ETFs will live. Think of it like a bank account, but instead of holding cash, it holds investments. For a beginner John's age, Fidelity, Schwab, or Vanguard are the right options. All 3 are free to open, no account minimums, no monthly fees, and all 3 support every ETF in this video. The process takes about 10 minutes online. A name, an address, a social security number, and a bank account to link. That's everything required. The second step is funding the account. So John transfers $5,000 from his bank account into his new brokerage account. Most brokerages process the transfer in 1 to 3 business days. The money doesn't need to be invested immediately. It sits as cash until John is ready to buy. One thing worth doing before buying anything, turn on automatic dividend reinvestment. It's usually a single toggle in account settings. When dividends are paid out and every fund in this portfolio pays them, instead of sitting as cash, they automatically buy more shares. Free compounding that starts from the first dividend John receives and never stops. Turn it on once and just forget about it. The third step is buying the ETFs. John searches the ticker VOOQQQVXUS, enters the dollar amount he wants to invest in each one based on the allocation, confirms the order, done. The whole process from search to confirmation takes under 5 minutes per fund. One important note for anyone watching this who has less than $5,000 right now, most major brokerages support fractional shares. That means John doesn't need the entire amount to buy 1 full share of VOO at whatever it's trading for today. He can put in $50, $100, $500, whatever he has. The brokerage buys the fraction of a share that amount covers. So the minimum you can contribute isn't a specific share price. The minimum is whatever John has available to invest right now. That's the entire buying process. No special knowledge, no financial advisor sitting across a desk. If John can order something online, he can buy an ETF. It's that simple. Now the most important question, what does John actually do next? This is the part most people get wrong. John has his portfolio. The ETFs are purchased. The account is funded. And now every instinct he has is going to tell him to do something. Check the balance, react to the news, move money around when one fund is outperforming the other. That instinct is the most expensive thing in investing. What John actually does, however, is nothing. He doesn't check the portfolio every morning. He just lets the portfolio do what it was built to do and gets out of the way. 3 things specifically. The first is holding through the drops. The portfolio will go down. Not might, will. 20%, maybe 30% at some point. Every major downturn in history, though, has been followed by a recovery. The investors who lost money permanently weren't the ones who held, they were the ones who sold and never got back in. John holds, no matter what. The second is letting dividends keep reinvesting automatically. John set this up automatically before he bought his first share, but it's worth understanding why it matters. Every quarter, the funds in John's portfolio pay out dividends. Without automatic reinvestment, that cash just sits there doing nothing. With it, Those dividends immediately buy more shares. More shares generate more dividends next quarter. Those dividends buy even more shares, and that cycle runs in the background. The third is reviewing once a year. Not once a week, not once a month, just once a year. John opens his brokerage account, looks at his allocations, and checks whether the balance between VOO, QQQ, and VXUS has drifted significantly from where it started. If QQQ has had a great run and now makes up 45% of the portfolio instead of 30%, John rebalances, sells a little QQQ, buys a little VOO and VXUS, and brings the allocation back to where it was originally built to be. If nothing is shifted dramatically, John just closes the app and goes back to his life. Listen, that's the entire maintenance plan. One check per year. Rebalance if needed. Everything else, leave it alone. Now, here's what the future projections look like when John follows these steps. So we know John put $5,000 into the starter portfolio one time. Based on the projections, year one, the account sits at $5,745. That's not a typo, it's only been 12 months. The $745 gain is the first sign the money is moving, but compounding hasn't had time to build on itself yet. This is the part most beginners misread. Year one looks slow, because it is slow. What matters isn't what year one looks like, it's what year one starts. By year 10, the account will grow to $19,529. John hasn't added a dollar since day one, and his $5,000 is now approaching $20,000, nearly 4 times what he started with. The compounding is building momentum now. By year 20, the portfolio reaches $73,239. John is somewhere in the middle of his career. His one decision made years ago with just $5,000 he wasn't sure was enough is now sitting at over $70,000. The same dollar that took 10 years to become $19,529 took the next 10 years to become $73,239. Then year 30 lands at $268,954, $250,000 from a one-time $5,000 investment. Total value added over 30 years, $263,954. Capital appreciation drives $257,930 of that. The blended 13.64% average annual appreciation doing its job across 3 decades. Dividend reinvestment adds another $6,024 on top. That's the automatic reinvestment John set up on day one, running in the background for 30 years without him touching a thing. But what if John wanted more than $250,000? What if he was willing to take on more risk and push that same $5,000 even further? Same starting point, same $5,000, same one-time investment, but with 2 changes to the starter portfolio, and the year 30 number looks completely different. This is the aggressive growth portfolio, and it's not for everyone. It's not designed to be. It's for the investor who has a genuine 30-year timeline, who understands that more growth means more volatility along the way, and who also won't panic when the portfolio drops hard in a bad year. If that's not John, the starter portfolio already has his answer. If it does sound like John, well, here's what the numbers look like. 2 things changed from the starter portfolio. Number 1, VXUS is out. The global diversification layer gets replaced entirely by VGT, the Vanguard Information Technology ETF. VGT tracks over 300 U.S. technology companies. Apple and Nvidia alone make up over 30% of the fund. Semiconductors, software, hardware, IT services, pure technology, nothing else. Expense ratio is 0.09%. Average annual share price appreciation, 21.54%, the highest of any fund in either portfolio. VGT's job here is one thing and one thing only: maximum long-term growth. It does that job better than anything else in this video. It also drops harder than anything else in this video when technology has a bad year. That's the trade. With this aggressive growth portfolio, the allocation also shifts to reflect the higher risk profile. VOO drops from 50% to 40%, so $2,000. Still the anchor, slightly smaller to make room. QQQ steps up from 30% to 35%, $1,750. More NASDAQ concentration, more growth engine. Then VGT comes in at 25%, $1,250, the most aggressive position in either portfolio doing the heavy lifting on the growth side. Across the three funds, the aggressive growth portfolio blends out to a 0.71% dividend yield, a 6.26% dividend growth rate, and an average annual appreciation of 17.35%, the highest blended appreciation of either portfolio in this video. Here's what that portfolio looks like over the long run. Year 1 comes in at $5,903, a slightly stronger start than the starter portfolio, the higher blended appreciation already pulling ahead in the first 12 months. By year 10, the account grows to $25,716. The starter portfolio sits at $19,529 at the same point. That's a $6,187 difference from the same $5,000 inside the first decade, and the gap is only going to widen from here. Year 20 hits $128,850, nearly double what the starter portfolio produces at the same point. 2 decades of concentrated technology exposure compounding, and the distance between the two portfolios is now impossible to ignore. Then year 30 lands at $640,401. Starter portfolio, $268,954. Aggressive growth portfolio, $640,401. The gap between them is $371,447 from the same $5,000. Same starting point, same timeline, same one-time investment. The difference is the risk factor. How much risk is John willing to stomach? Investors spend years chasing the perfect portfolio, jumping between funds, second-guessing every move, and ending up with a mess of positions they can barely explain. Because somewhere along the way, investing got complicated. More funds, more sectors, more opinions, and somehow more confusion. But what if the smartest portfolio this year isn't the most complex one? What if it's just 3 ETFs? One to anchor your money, one to grow it fast, and one to pay you while you wait. In this video, I'm going to show you exactly how to build that portfolio, even if you're starting with just $10 a day. We'll look at how each ETF performs on its own, then combine all 3 into a single portfolio. And at the end, I'll show you how that portfolio could turn $10,000 into over $500,000, and how that same portfolio could turn just $10 a day into over $1 million. But before we get into the portfolio, let's talk about where most people actually end up, because you need to see what the alternative looks like. The average American family has around $334,000 saved for retirement. That's it. And that's after decades of working, saving, and trying to do the right thing with their money. And look, $334,000 sounds good, sounds like a lot, until you actually try to live off of it. At a standard 4% withdrawal rate, that's only about $13,000 a year. That's grocery money, not retirement money. Here's the thing, if you take the 3 ETFs I'm about to show you, put in just $10 a day, reinvest dividends, and leave it alone, your portfolio could grow to over $1 million over the long term from $10 a day. That gap between where most people end up and where this strategy could take you, that's exactly what this video is about. So where does this 3 ETF portfolio idea actually come from? It's not something I made up. It's rooted in one of the most proven investing frameworks ever built, the 3-fund portfolio. This was a strategy popularized by the Bogleheads, a community of investors who follow the philosophy of Vanguard's founder, Jack Bogle. The original idea was simple. Own the entire market with just 3 funds: total U.S. stocks, total international stocks, and bonds. Don't pick winners, don't time the market, just own everything, keep the costs low, and leave it alone. And it worked for decades. But here's the thing about this year. The world Jack Bogle was investing in looks very different from the one we're in now. International funds have spent years underperforming U.S. markets. Bonds are paying less in real terms than they used to. The logic behind those 2 slots still makes sense. You want global growth exposure, and you want income and stability, but the original tools for those jobs just aren't the best ones anymore. So what I'm doing in this video is keeping the Boglehead's backbone: 3 funds, 3 jobs, clean and simple, but upgrading 2 of the 3 slots for the world we actually live in today. The foundation stays. Total Market ETF handles that, and it's as close to the original Boglehead's vision as you can get. But the international slot and the bond slot, those get a 2026 and beyond upgrade. And I'll show you exactly why when we get there. First though, before you put a single dollar anywhere, there are 3 rules you need to know. Rule 1. Pick 1 ETF from each category. Not 2, not 3, just 1. Each slot in this portfolio has a job to do, and doubling up doesn't make it stronger, it just makes it messier. 1 fund per category, keep it clean. Rule 2. Know your goal. This strategy works differently depending on where you are in life. If you're in your 20s or 30s, you've got time on your side and you might want to lean heavier into growth. If you're closer to retirement, income and stability matter more. There's no wrong answer here, but you need to know which one you're building toward before you start, and we'll come back to this at the end. Rule 3. Stay consistent. Good fund picks mean nothing if you bail at the first sign of trouble. Reinvest, don't panic, and let time do the heavy lifting. Those are the 3 rules. Simple, but they matter. Now let's get into the portfolio, starting with the fund that anchors the whole thing. Every portfolio needs something at its core that you can trust no matter what the market's doing. Not the flashiest fund, not the fastest grower, just something solid, broad, and built to last. That's what this first ETF is. It's called VTI, the Vanguard Total Stock Market Index Fund ETF. And the name tells you exactly what it does. It owns the total U.S. stock market. Every publicly traded company in America, over 3,500 of them, in a single fund. So when you buy VTI, you're not making a bet on any one company or any one industry. You're making a bet on the entire American economy. And historically, that's been one of the safest long-term bets you can make. Think about what that actually means in practice. When tech pulls back, healthcare might be carrying the weight. When consumer stocks struggle, industrials could be picking up the slack. The whole market balances itself out over time, and you're along for the entire ride without having to pick winners. This is also the ETF that stays most true to what the Bogleheads originally built. Jack Bogle's whole argument was that you can't consistently beat the market, so you're better off just owning it. VTI is exactly that, the whole market at one of the lowest costs you'll find anywhere. It's not going to be your fastest grower. We've got another ETF for that, but it gives your portfolio a foundation that can weather recessions, crashes, and whatever the news cycle throws at it next. You need that anchor before anything else. Now let's talk numbers. VTI currently pays a dividend yield of 1.13%, and those dividends have grown at an average of 6.16% per year over the last 10 years. On top of that, the fund has averaged 12.45% in annual share price growth over the same period. So what does that actually look like in your pocket? If you put $10,000 into VTI today and reinvest every dividend you receive, after just 1 year, your portfolio is projected to grow to $11,358. Give it 10 years, and that same $10,000 could be valued at $34,883. By year 20, you're looking at $117,350, and by the time you hit year 30, the projections show that initial $10,000 growing to $387,355. Out of that total growth, $368,471 would come from capital appreciation and $8,884 from reinvested dividends. So the total value added to your original investment could be $377,355. That's what a reliable anchor looks like over the long term, building wealth in the background while you get on with your life. And honestly, VTI alone could already get you past that $334,000 average retirement savings figure we talked about earlier. But matching the average was never the point. The next ETF is what starts pulling you well beyond it. Next, I'll show you the remaining 2 ETFs, and at the end, I'll combine all 3 into a single portfolio that could turn $10,000 into over $500,000. And just $10 a day into over $1 million. But first, let's talk about the growth slot in this portfolio. In the original Bogleheads model, this slot was for international stocks, the idea being that different countries perform differently at different times, so spreading across borders smooths out your risk. And that made a lot of sense 20 years ago. But the world looks differently now. The biggest American companies aren't really American anymore. Apple sells more iPhones in Asia than in the US. Microsoft runs cloud infrastructure across Europe. NVIDIA's chips are powering AI data centers on every continent. If you already own the top US companies, you're getting global exposure through the companies actually winning the global race. So instead of parking money in a generic international fund that's spent years underperforming, this slot gets an upgrade. And that upgrade is QQQ, the Invesco QQQ Trust. QQQ tracks the NASDAQ 100. That's the 100 largest non-financial companies listed on the NASDAQ exchange. And what you get inside is a concentrated bet on the companies shaping how the world works right now. We're talking semiconductors, artificial intelligence, cloud computing, digital advertising, biotech, e-commerce. These aren't speculative startups hoping to figure it out. These are profitable, cash-rich businesses that dominate their industries globally. Now, QQQ isn't for the faint-hearted. It moves faster than VTI. And when the market dips, QQQ can dip harder. But when it recovers, and historically it always has, it comes back fast and it comes back strong. The companies inside it tend to come out the other side stronger than before. And that's the trade-off with this slot. More volatility, more growth potential. And over time, the growth has been hard to argue with. QQQ currently pays a dividend yield of 0.46%. This isn't an income fund, so don't expect big payouts. Those dividends have been growing at 9.73% per year over the last 10 years. But the real story here isn't the share price growth. QQQ has averaged 19% in annual appreciation over the last decade. 19% per year on average for 10 years. Let that sink in for a second. So what does that actually look like in your pocket? If you put $10,000 into QQQ today, the projections show your portfolio at $11,946 after just 1 year. Give it 10 years, and that climbs to $58,441. By year 20, you're sitting at $336,081, and at year 30, this is where it gets hard to believe, that single $10,000 could be valued at $1,920,977. Nearly $2 million from one investment. Of that total growth, $1,905,620 comes from capital appreciation and $5,357 from reinvested dividends, bringing the total value added to your original investment to $1,910,977. Now, and this is worth saying, that number assumes a consistent 19% annual return over 30 years. Markets don't move in straight lines, and there will be years QQQ drops hard. But if the last decade is anything to go by, the long-term trajectory of the companies inside this fund is difficult to bet against. That is your growth engine. Given enough time, this is the fund that does the heavy lifting on your total returns. But here's the thing about growth. It doesn't pay your bills while you're waiting for it. So what happens in the years when QQQ is pulling back? What's actually putting money in your pocket? And that's the job of our third ETF. In the original Bogleheads model, this slot belongs to bonds. And for a long time, that made sense. Bonds are stable, they pay interest, they smooth out the rough patches when stocks are falling. The logic was solid. But bonds have a ceiling. You lend money to a government or a company, they pay you a fixed rate of interest, and that's more or less it. No growth engine, no compounding, and in a world where inflation is eating away at purchasing power, a fixed low return starts to feel less like safety and more like standing still. So this slot gets the second upgrade in our portfolio, and the ETF that fills it up is SCHD, the Schwab U.S. Dividend Equity ETF. SCHD is selective about what it owns. It screens for companies with strong balance sheets, a track record of paying consistent dividends, and the financial strength to keep raising those payouts even when times get tough. What you end up with is a basket of battle-tested businesses spread across consumer staples, healthcare, industrials, and financials, companies that have proven they can generate real cash and share it with investors year after year. And that's really the key difference between SCHD and a bond fund. A bond pays you a fixed rate and stops there. SCHD pays you a dividend that grows every year. You're getting income today, more income next year, and more the year after that. The compounding effect of a growing dividend is something a bond simply can't replicate. And on top of that, you also get share price growth. So 3 benefits compared to 1 benefit with the bond. And unlike QQQ, SCHD won't keep you up at night. It's not immune to market swings, nothing is, but the types of companies inside it tend to hold up better when things get bumpy. That's the stability function this slot is supposed to provide, just delivered through dividend equity instead of fixed income. SCHD currently pays a dividend yield of 3.39%, the highest of the 3 ETFs in this portfolio. Those dividends have grown at an average of 10.61% per year over the last 10 years, and the fund has averaged 8.92% in annual share price appreciation over the same period. So what does this actually look like in your pocket? If you put $10,000 into SCHD today and reinvest every dividend you receive after 1 year, the projections show your portfolio at $11,231. Give it 10 years and that same $10,000 could be valued at $32,704. By year 20, you're looking at $113,469, and by year 30, that $10,000 is projected to grow to $422,014, with around $20,326 coming in every year in dividend income. That's roughly $1,694 landing in your account every single month passively from one ETF. Of that total value added, $264,921 comes from capital appreciation and $147,094 from reinvested dividends, bringing the total value added to your original investment to $412,014. So now all three pieces are on the table: an anchor, a growth engine, and an income layer. 3 ETFs, 3 completely different jobs, and together, all three, the portfolio takes on its own identity. And here's how we're putting it together. $10,000 split equally across all 3 ETFs. Roughly $3,333 into VTI, $3,333 into QQQ, and $3,333 into SCHD. Now, you can adjust that weighting based on where you are in life. More into QQQ if you want to lean into growth, and more into SCHD if income matters more right now. But for this video, equal weight keeps things clean and lets each ETF do its job properly. Here's how the combined numbers work. Since we're splitting things equally across all 3 ETFs, we just take each metric and average it out across the 3 funds. Take the dividend yield. VTI is at 1.13%, QQQ at 0.46%, and SCHD at 3.39%. Add those together and divide by 3, and your combined portfolio yield comes out to 1.66%. Same method for the dividend growth rate. Average the 3 and you land at 8.83% per year. Do the same for the share price appreciation and you get 13.46% annually. Those 3 numbers, 1.66%, 8.83%, and 13.46%, are what drive everything you're about to see. So, let's say you put $10,000 into this portfolio. Here's what that looks like in the long run. After 1 year, the projections put you at $11,512. 10 years in, and you're looking at $39,804. Year 20 takes that to $151,525, and by year 30, that original $10,000 is projected to have grown to $560,970, with around $2,068 coming in every year in dividends. Of that, $527,476 comes from capital appreciation and $23,494 from reinvested dividends, with total value added sitting at $550,970. Remember that $334,000 average retirement savings figure from earlier? This portfolio just beat it by over $226,000 from a single one-time investment of $10,000, with nothing added after that. But what if you don't have $10,000 to start with? What if you're just starting out and that kind of lump sum isn't on the table right now? That's where it gets really interesting, because this same portfolio works just as well with something far more manageable. Just $10 a day. No lump sum, no windfall, no perfect moment. Using this approach, by the end of year 1, you would have invested $3,650. This sets the stage for future growth. By year 10, that daily habit of investing $10 a day is projected to be worth $73,084. By year 20, you're looking at $349,627, and by year 30, that $10 a day is projected to grow into $1,364,774, over $1 million from $10 a day. By that point, the portfolio could be paying you $5,018 every year in dividend income, around $418 landing in your account every single month, passively. Of that total growth, $1,203,975 would come from capital appreciation and $51,299 from reinvested dividends, bringing the total value added over the life of the portfolio to $1,255,274. And just to put that in perspective, over 30 years, you'd have put in around $109,500 in total contributions. The portfolio builds the rest. That $334,000 average we kept referencing, with just $10 a day, this portfolio is projected to hit 4 times that number. 4 times from a daily coffee budget. Almost every VOO versus SCHD comparison gets it wrong. People argue about dividend yield or growth or which one is safer, but none of that answers the real question. What does your life actually look like after you've held it for decades? See, that's where most investors get blindsided. In this video, I'm comparing VOO and SCHD the way an investor should. I'm taking VOO and SCHD and putting the same $100,000 into each one. No extra money added, just letting the time do its work. We'll look at what each ETF actually holds, how they grow, how much income they pay, and how they behave when markets go up and down. And in the end, I'll show John how one choice ends up adding close to $1 million extra, while the other pays more than $17,000 extra per month in dividends, a difference most people never see coming when they start. To understand why this happens, we need a bit of context first. Money decisions don't happen in isolation. You're making them while prices keep climbing, headlines keep changing, and the future never feels fully settled. That's why putting $100,000 to work feels heavy. It's not just about getting a good return, it's about whether this choice gives you options later and holds up when things don't go perfectly. Some people care most about growth. They're okay watching their balance swing around if it means the money compounds faster over time. Others care more about income. They want cash showing up regularly, even if the portfolio grows at a slower pace. This is where VOO and SCHD split apart. VOO works best if you trust long-term growth and can tune out the noise along the way. SCHD, on the other hand, makes more sense if you value steadiness and seeing real income hit your account. One leans into patience, the other leans into consistency. Problems start when people choose investments that don't match how they behave. They pick what sounds best on paper, then second-guess it when the market tests their nerves. That's usually not a math problem. It's a behavior problem. That's how good strategies fail. Now, before comparing performance numbers, it helps to understand what you're actually buying. VOO and SCHD may both be ETFs, but they're built for very different jobs. That design choice explains why their results drift apart over time. VOO tracks the S&P 500 and holds about 519 of the largest U.S. companies. When the biggest businesses grow, VOO grows with them. There's very little intervention, companies naturally rise and fall, and the fund rarely changes its lineup. VOO is designed to capture broad market growth and let long-term compounding do the work. The companies inside VOO are built to grow. VOO's largest companies reinvest aggressively, expand globally, and prioritize increasing earnings over paying dividends. Their value comes less from cash today and more from what they can become in the future. That shows up in its sector exposure. Technology, communication services, and consumer innovators make up a large portion of the fund. These sectors tend to do well when the economy is expanding, which is why VOO often shines during strong markets. The trade-off is volatility. Growth-heavy sectors react quickly to interest rates and slowdowns, making short-term moves less predictable. SCHD is built with a completely different priority. Instead of covering the whole market, it holds about 102 companies chosen for dividend history, balance sheet strength, and consistency. If a company stops meeting those standards, it gets replaced. The goal isn't maximum exposure, it's dependable income. That shows in the types of businesses SCHD owns. It leans towards established cash-producing companies in areas like consumer staples, healthcare, industrials, and financials. These are businesses people rely on, no matter what's happening in the economy. Earnings tend to be steadier, and dividends stay front and center even during rough periods. That defensive mix changes how the fund behaves. SCHD usually doesn't swing as hard when markets drop, but it also doesn't sprint ahead when markets take off. Speed gets traded for steadiness. And once you understand how differently these ETFs are built, the first place that difference shows up is in the cash they send you. VOO does pay a dividend, but it's not the point of the fund. The yield sits around 1.12%. That income exists because large companies pay dividends, not because VOO is trying to generate cash for you. The dividend has grown over time, roughly 6.04% per year over the last decade, but it starts small. Early on, it barely registers. Most of the return is expected to come from the share price rising, not from the money hitting your account. SCHD takes the opposite approach. Its yield is much higher, around 3.59%, which means income matters from the start. On top of that, dividends have grown faster, about 10.61% per year over the last 10 years. That changes the role that dividends play. They're not a side effect, they are the engine. A meaningful portion of the total return comes from cash being paid out and reinvested along the way. This creates two very different experiences as an investor. With VOO, dividends are easy to ignore for a long time. Progress shows up mainly through a rising balance. With SCHD, dividends are hard to miss. They arrive regularly and make the portfolio feel alive, even during stretches when prices move sideways. What matters is what you want dividends to do for you. Are they a side benefit you reinvest, or the main reason you're investing in the first place? That answer points you toward the ETF that fits your goals. Before you decide which path makes sense, you have to look at what VOO gives up to chase growth. It chooses appreciation over income, and that choice creates a real gap over time. VOO's strength comes from price appreciation. Historically, its annual share price growth has been much higher, averaging 13.92% per year over the past decade. That doesn't mean it rises smoothly. It doesn't. Some years are explosive, others feel disappointing. But over long stretches, compounding does the work in the background. Gains stack on top of gains, and the size of your portfolio becomes the engine driving future growth. SCHD grows too, just at a slower pace. Its average annual price appreciation has been 9.23%. That's still strong, but the compounding curve is flatter. More of SCHD's total return comes from dividends rather than price movement. Growth is part of the picture, but it isn't the main driver. This gap is easy to brush off early. A few percentage points don't seem like much at first. Year to year, the difference feels manageable. But stretch that out over decades, and the math starts to separate them. Now, in the end, I'll show you how this few percentage difference can result in a portfolio value difference of close to $1 million. Compounding favors the fund that grows faster, and the longer you stay invested, the more noticeable that gap becomes. And to see how that gap shows up in real life, you have to step away from averages and look at actual stretches of time. Short-term returns matter because they shape how investors feel long before long-term compounding finishes its job. When you line up VOO and SCHD across real time frames, the contrast is consistent. Over the last year, VOO returned about 13.6%, while SCHD came in closer to 4.5%. As large cap growth picked up, VOO moved quickly. SCHD stayed positive, but most of its progress came from dividends rather than the share price rising. Stretch that out to 3 years and the gap gets much wider. VOO gained roughly 71.9%, while SCHD returned about 14.7%. This period included a major drawdown and recovery. VOO fell harder during sell-offs, but it recovered faster and pushed to new highs. SCHD absorbed less damage, but its rebound was slower and capped. The same pattern shows up over 5 years. VOO delivered close to 79% compared to about 33% for SCHD. Zoom out to 10 years, and the difference stops looking temporary. VOO's price growth topped 255% over the decade, while SCHD landed closer to 132%. That gap built up across multiple market cycles as earnings expanded and valuations grew. Living through this creates two very different experiences. One portfolio swings more but compounds faster. The other trades upside for steadiness and income. That said, returns only tell half the story. The other half is how an investment behaves when things don't go as planned. This is where the difference between VOO and SCHD becomes very real. VOO tracks the S&P 500, so its risk profile closely follows the overall stock market. When markets are strong, that works beautifully, but when markets fall, VOO falls with them. Its beta sits around 1, meaning it moves almost lockstep with market swings. During major pullbacks, VOO can drop fast and deep, especially because technology and growth stocks make up a large part of the fund. SCHD, on the other hand, moves through stress differently. It holds fewer stocks, focuses on established dividend-paying companies, and leans toward defensive sectors like consumer staples, healthcare, and energy. The result is lower volatility. SCHD usually doesn't fall as hard during market stress, and its price movements tend to be smoother. Dividends keep coming in even when prices stall or fall, which changes how those periods feel to live through. This doesn't mean SCHD is safe in the sense of never losing value. It still drops during bad markets. The difference is speed and depth. VOO's drawdowns are sharper, while SCHDs are usually shallower and slower. This matters more than people expect. Investors often say they can handle volatility, but real drawdowns test that belief. Some investors panic when portfolios drop quickly, even if long-term returns are strong. Others feel more comfortable seeing a steady income arrive during rough periods. And that brings up another overlooked factor: how easily these ETFs actually trade in market conditions. So performance gets most of the attention, but execution matters just as much, especially when real money is involved. This is where size and liquidity start to separate VOO and SCHD in a very practical way. VOO is massive. It manages around $1.4 trillion, making it one of the largest ETFs in the world. SCHD is still large and well established at roughly $76 billion, but it's operating on very different scales. You feel that difference first in liquidity. VOO trades millions of shares every day with very tight bid-ask spreads. Buying or selling happens fast, and the price you see is usually the price you get. Whether you're putting in a few $1,000s or moving a much larger amount in millions, execution stays smooth and predictable. SCHD trades actively too, but it doesn't have the same depth. For most long-term investors, that won't cause problems, but larger orders can move the price a bit, and spreads tend to widen more when markets get choppy. For long-term holders, this may not matter much. For anyone deploying large sums or rebalancing frequently, it's an important factor. Fund size also reflects how these ETFs are used. Big institutions care about scale and reliability. They need products that can handle large flows without distortion. That's why VOO shows up as a core holding in pensions, endowments, and other large portfolios. It's built to absorb capital without drama. That difference explains a lot about how professionals think about these funds. VOO often forms the foundation, and income-focused strategies like SCHD get added on top. Looking at how institutions behave makes that picture even clearer. Over the last 12 months, VOO attracted about 3,104 institutional buyers compared to 1,786 for SCHD. That gap alone shows how often VOO is used as a default building block. Institutions don't spend much time debating whether they want broad market exposure. They already know they do. VOO is simply how they get it. The flow data backs that up. VOO pulled in roughly $158 billion in institutional inflows while seeing about $22.7 billion in outflows. Even after routine rebalancing and profit-taking, that's still enormous net demand. Quarter by quarter, inflows consistently outweigh outflows, especially during strong market periods. This isn't short-term positioning, it's long-term accumulation. SCHD tells a different story. It brought in about $17.35 billion in inflows, with $4.05 billion flowing out, and far fewer total participants. Last year's quarterly chart shows buying and selling staying more balanced. That lines up with how it's used. SCHD comes into portfolios when income is needed and gets trimmed when capital shifts elsewhere. As for the analyst ratings, the aggregate rating for SCHD sits at 2.49, labeled Hold, based on 563 analyst ratings covering about 77.3% of the portfolio. The price target is flat at $28.90 with no meaningful upside or downside range built in. Expectations here are steady, not aggressive. Now look at short interest. SCHD has about 4.26 million shares sold short out of about 2.62 billion outstanding shares, putting short interest at just 0.16% of float. That short interest ratio is only 0.3 days to cover, and short interest has fallen more than 7% month over month. In plain terms, all of this means very few traders are betting against SCHD, and the ones who do have been backing off. VOO shows the same pattern, just on a much larger scale. Its aggregate analyst rating is 2.86, a moderate buy based on more than 847 analyst ratings covering roughly 51.4% of the portfolio. The price target sits near $633.45, which points to very little short-term upside. Short interest in VOO is also extremely low. About 3.63 million shares are sold short out of 1.34 billion outstanding shares, or roughly 0.27% of float. The short interest ratio is again 0.3 days, and short positions dropped more than 56% month over month. Here's the real takeaway. Analysts may debate upside, but traders aren't positioning for downside. Both ETFs show minimal short pressure, signaling confidence in structure and durability rather than speculation. Okay, before looking at what a $100,000 investment would turn into in a side-by-side comparison between these two ETFs, let's quickly cover fees and efficiency, as they play a very important role. I know, fees are boring, but over decades, they decide who wins. On paper, both of these ETFs are cheap, but cheap and cheapest are not the same thing. VOO charges a total expense ratio of 0.03%, while SCHD comes in at 0.06%. That difference looks tiny. On a $100,000 investment, we're talking about $30 a year versus $60 a year. Easy to ignore. Until you stretch that timeline to 20 or 30 years. VOO's cost advantage comes from how simple it is. It tracks the S&P 500, rebalances mechanically, and doesn't need frequent changes. That's why its management fee is just 0.02%, with total expenses staying extremely low. Less activity means fewer hidden trading costs, less turnover, and less drag on long-term returns. SCHD is still inexpensive, but it's more hands-on. It screens for dividend-paying companies, removes underperformers, and adjusts holdings based on dividend quality. That extra work adds a little more cost. Its total expense ratio of 0.06% is still far below the industry average, but it reflects higher turnover and more frequent rebalancing behind the scenes. This matters because costs don't just reduce returns once, they compound in reverse. Every dollar paid in fees is a dollar that doesn't grow, doesn't compound, and doesn't earn future returns. Over long periods, that gap widens, especially when growth is doing most of the work. Which brings up the next question. Does SCHD's higher income and more attractive approach make up for that added cost? Or does VOO's efficiency keep pushing it further ahead as time stretches out? Let's do a head-to-head comparison and find out. With VOO, the engine is price growth. VOO has a 13.92% annual price appreciation and a 1.12% dividend yield, growing at about 6.04% per year. The portfolio grows fast. Based on these metrics, after 1 year, a $100,000 investment would be valued at $115,040. At the 10-year mark, projections put it around $394,664. By year 20, the portfolio would be worth close to $1.5 million, and after 30 years, projections show a value of roughly $5.59 million. Where that value comes from is the key point. Out of the $5.49 million added over the 30-year period, more than $5.4 million would come from capital appreciation. Dividends play a supporting role, projected to contribute about $80,509 in total over the full timeline. Even after 3 decades, income remains relatively small. Annual dividends are projected at around $5,081 per year, or roughly $423 a month. The portfolio would be doing exactly what it's designed to do, growing in size, not generating cash flow. SCHD projects a very different outcome. Its price growth assumption is lower at 9.23%, but the dividend side is doing all the heavy lifting here. Starting with a 3.59% yield and a 10.61% dividend growth rate, the compounding effect of reinvested income is massive. After 1 year, $100,000 in SCHDs projected to grow to $112,820. At 10 years, projections place it around $340,999. By year 20, it would cross $1.22 million, and at the 30-year mark, the portfolio is projected to finish near $4.63 million. The makeup of that value looks very different. Out of the roughly $4.5 million total portfolio value, about $2.96 million would come from capital appreciation, while roughly $1.5 million would come from reinvested dividends. That leaves SCHD about $950,000 behind VOO in total value. The trade-off shows up in income. After 30 years, SCHD is projected to generate about $215,998 per year, or roughly $18,000 per month. That income is driven by approximately $1.57 million in reinvested dividends compounding over time. So there you have it. If you go the growth route, VOO would add an extra $950,000 to your portfolio over 30 years. If you go with SCHD, it would pay about $18,000 a month in income instead. That's the trade-off. A much larger balance or a steady paycheck? Choose the one that fits how you want your money to work for you. If you invested $100,000 into an index fund today, which one would actually grow your money more? Fidelity or Schwab? That's the $1.5 million question we're looking into. In this video, we're putting $100,000 into Fidelity's index funds versus Schwab's head-to-head. We're talking real numbers, fees, performance, dividends, and how all of that compounds over decades. Both providers offer funds across the same categories, making this a genuinely fair matchup. We'll go head-to-head across 5 rounds. Fees, the S&P 500, total market, bond market, and international. And at the end, you'll see how one of these providers leaves John with a bigger portfolio, $1.5 million more to be exact. But before we get into the rounds, let's quickly cover the basics, because if you're newer to investing, this will make everything that follows a lot clearer. An index fund is basically a basket of investments. So instead of picking individual companies and betting your money on your own instincts, you spread it across hundreds or even thousands of stocks all at once. Most index funds follow a specific market benchmark, like the S&P 500, and aim to match its performance as closely as possible. Because they don't require a team of managers constantly trading in and out of positions, the costs stay extremely low. You invest once, leave it alone, and let time do the heavy lifting. So the real question is, who's offering the better one? Is it Fidelity or is it Schwab? Fidelity, founded back in 1946, manages over $18 trillion in assets. In 2018, they made history by launching the world's first zero expense ratio index funds. Zero, as in nothing. We'll unpack what that means in just a minute. On the other hand, Charles Schwab, founded in 1971, manages just under $12 trillion in assets. They built their reputation pioneering the discount brokerage model. Their index fund and ETF lineup consistently ranks among the cheapest in the industry. On the surface, both look like safe bets. Both are legitimate, battle-tested institutions. Both deserve your consideration. But John's not here to pick a brand. He's here to pick the one that grows his $100,000 the most. And when you're investing that kind of money, small structural differences don't stay small. They compound over decades. So let's start with the number that matters most for any passive investor. Here's the good news for John. Both Fidelity and Schwab are among the lowest cost investing platforms out there. Both offer commission-free trading on U.S. stocks, ETFs, and most mutual funds. Neither charges account minimums for standard brokerage or IRA accounts. But dig a little deeper, and the differences start to show. On expense ratios, that's the annual fee a fund takes from your investment automatically every year. The base cost from either Schwab or Fidelity is the same, 0.02%. But Fidelity offers a lineup of index funds with a 0% expense ratio, including FZROX, FZILX, FNILX, and FZIPX. Schwab has no direct equivalent. For a pure buy-and-hold investor, that is a structural cost advantage that cannot be ignored. On options trading, both firms charge 65 cents per contract. Neither charges annual account maintenance fees on standard accounts. They're perfectly tied there. So John looks at the full picture and gives this round to Fidelity. Their zero expense ratio funds are genuinely unique in the market. For cost-conscious, long-term investors, Fidelity simply costs less. But fees are only one piece of the puzzle. The real test is what the money actually does once it's invested. And the most popular place to start that test is the S&P 500. You've probably heard this name more than any other in investing. It is the gold standard of U.S. stock market investing. The S&P 500 tracks 500 of the largest publicly traded American companies. And when people say the market went up, they're almost always talking about the S&P 500 moving higher. Over the last 10 years, it's delivered more than 14% average annual returns. That's one of the strongest long-term track records in investing history. Both Fidelity and Schwab have built their flagship funds around this benchmark. Fidelity's version is FXAIX, the Fidelity 500 Index Fund. Schwab's is SWPPX, the Schwab S&P 500 Index Fund. Same 500 companies, nearly identical proportions. On the surface, they look almost identical, but John wants to see for himself what $100,000 actually does in each one. He starts with Fidelity's FXAIX, their flagship S&P 500 fund. John puts in his $100,000, sets every dividend to reinvest, and lets the calculator run. After just 1 year, his portfolio would grow to $114,090. Fast forward to 10 years, and it would be sitting at $362,214. Stretch that out to 20 years, and John's looking at $1,259,752. And after 30 years, his original $100,000 is projected to reach $4,310,902. Out of that, $4,153,035 would come from capital appreciation and $57,867 from reinvested dividends. That's $4,210,902 in total value added to his initial investment. Now John runs the exact same scenario with Schwab's SWPPX. Same $100,000 going in, same dividend reinvestment, same timeline. After 1 year, his portfolio would grow to $114,010. After 10 years, $363,470. After 20 years, $1,279,591, and after 30 years, Schwab's version is projected to reach $4,427,056. Out of that, $4,232,232 comes from capital appreciation and $94,824 from reinvested dividends, a total of $4,327,056 in value added. So Schwab comes out ahead by $116,154. Both funds hold the exact same 500 companies in nearly identical proportions. So what's actually creating that gap? Well, it comes down to one thing: dividend growth. SWPPX has been growing its dividend at 7.07% annually compared to FXAIX's 4.16%. That might not sound like much year to year, but over 3 full decades, that difference compounds into real money sitting in John's account. So he gives this round to Schwab, and it's 1 point each. But that $1.5 million gap I mentioned at the start, it doesn't come from the S&P 500. It comes from the next 3 rounds, and the first one is where the numbers start to separate. What happens when John goes beyond the 500 largest companies and puts his $100,000 into the entire U.S. market? So the S&P 500 covers the 500 largest U.S. companies. The total market fund goes much further, adding mid-size and small companies. The S&P 500 completely excludes. These smaller firms often carry higher growth potential, and including them gives a portfolio genuine depth. Think of it this way: if the S&P 500 is the skyline, the total market fund is the entire city. Fidelity's entry is FZROX, Fidelity's Zero Total Market Index Fund. Schwab counters with SWTSX, the Schwab Total Stock Market Index Fund. Both cover roughly 2,500 to 2,900 publicly traded U.S. companies and follow similar market cap-weighted strategies. The holdings overlap significantly, but John's already learned from the S&P 500 round that similarity doesn't mean identical. John starts with Fidelity's FZROX, their total market fund. He puts in his $100,000, sets every dividend to reinvest, and lets it run. After just 1 year, his portfolio is projected to grow to $114,470. Fast forward to 10 years, and it would be valued at $377,990. Stretch that out to 20 years, and John's looking at $1,382,428. And after 30 years, his initial $100,000 is projected to reach $4,968,992, paying around $7,022 in annual dividend income. Out of that, $4,772,602 would come from capital appreciation and $96,390 from reinvested dividends. Total value added to his original investment, $4,868,992. Now he runs Schwab's SWTSX through the same scenario. Same $100,000, same reinvestment, same timeline. After 1 year, his portfolio would grow to $113,670. Fast forward to 10 years, $350,529. Stretch that to 20 years, $1,182,861. And after 30 years, Schwab's total market fund is projected to reach $3,922,518, paying around $3,967 in annual dividend income. Out of that, $3,753,921 would come from capital appreciation and $68,597 from reinvested dividends. Total value added, $3,822,518. Fidelity finishes ahead by $1,046,474. This time, the main driver isn't dividend growth, it's share price appreciation. SWTSX posts 12.57% annually versus FZROX's 13.43%. That 0.06% gap doesn't sound like much, but give it 3 decades, and it compounds into a meaningful difference. This round goes to Fidelity. So that's 2 rounds for Fidelity, 1 round for Schwab. John's watching Schwab fall behind and wondering if it can fight back. And the next category is one most investors skip over entirely. That's usually a mistake. Bond index funds rarely get the spotlight, but for any investor serious about portfolio balance, they're not optional. They're what keep your portfolio steady when equity markets turn ugly. Now, bonds work differently than stocks, and it's worth understanding why. Share price appreciation in bond funds is often lower over time because bond prices move inversely to interest rates. That sounds alarming at first, but it's not the whole story. The real return engine in bond funds is the dividend income, paid out consistently, reinvested over time, and compounded across decades. That's where the numbers get interesting. Fidelity's fund here is FXNAX, the Fidelity U.S. Bond Index Fund. It tracks the Bloomberg U.S. Aggregate Bond Index, covering investment-grade bonds across government, corporate, and mortgage-backed securities. Schwab counters with SWAGX, the Schwab U.S. Aggregate Bond Index Fund, tracking the exact same Bloomberg benchmark, same index. But as John keeps learning, same index doesn't always mean same result. John starts with Fidelity's FXNAX, $100,000 in. After just 1 year, his portfolio is projected to grow to $112,630. Fast forward to 10 years, and it would be valued at $328,504. Stretch that to 20 years, and John's looking at $1,079,150. And after 30 years, his initial $100,000 is projected to reach $3,545,051, paying around $113,311 in annual dividend income, or $9,443 per month. Out of that, $2,463,089 would come from capital appreciation and $981,962 from reinvested dividends. Total value added to his original investment, $3,445,051. Now let's run Schwab's SWAGX through the same 30-year scenario with John's $100,000 invested. After just 1 year, his portfolio would grow to $112,470. Fast forward 10 years and it would be valued at $323,867. Stretch it out to 20 years and John's portfolio would be worth $1,048,900. And by year 30, his initial $100,000 is projected to reach $3,397,042, paying around $121,722 in annual dividend income, or $10,144 per month. Out of that total portfolio value, $1,065,523 would come from reinvested dividends, with share price appreciation sitting at $2,231,518. Total value added to the initial $100,000 investment would be $3,297,042. Here's what's interesting about this one. Schwab actually starts with a higher dividend yield, 4.03% versus Fidelity's 3.6%. On paper, that looks like an advantage. But Fidelity's dividend growth rate is stronger, 9.03% annually versus Schwab's 8.44%. And over 3 decades, that faster growth rate overtakes the higher starting yield and compounds the gap wider with each passing year. By year 30, Fidelity is paying $113,311 a year in dividends, while Schwab is paying $121,722. But Fidelity's overall portfolio value of $3,545,051 clears Schwab's $3,397,042 by $148,009. A narrower margin than the other categories, but again, a clear win for Fidelity. The score now stands at Fidelity 3, Schwab 1. The next category is the one that takes John's money outside the United States for the first time. Up to this point, every dollar of John's $100,000 has stayed inside the U.S. market. But with American stock valuations sitting at historically elevated levels, international diversification has become one of the most important conversations in investing right now. Developed market international funds give you exposure to large established economies outside of America, countries like Japan, Germany, the United Kingdom, France, and Australia. These markets tend to offer lower valuations and higher dividend yields than U.S. equities, and they can smooth out your returns when the American market hits turbulence. For a long-term investor, international exposure isn't just nice to have, it's a smart strategy. Fidelity offers FSPSX, the Fidelity International Index Fund. It tracks the MSCI EAFE Index, covering large and mid-cap stocks across 21 developed market countries outside of North America. Schwab counters with SWISX, the Schwab International Index Fund, which follows the exact same MSCI EAFE benchmark. Same index, same territory. But as John has seen 4 times now, same benchmark doesn't guarantee the same outcome. So let's say John puts $100,000 into Fidelity's FSPSX today. After just 1 year, his portfolio would grow to $109,900. Fast forward 10 years, and it would be valued at $257,026. Stretch it to 20 years, and John's portfolio would be worth $660,623. And by year 30, his initial $100,000 is projected to reach $1,697,973, paying around $47,123 in annual dividend income, roughly $3,927 a month. Out of that, $1,105,668 would come from capital appreciation and $492,305 from reinvested dividends. Total value added to his original investment, $1,597,973. Now, John runs Schwab's SWISX through the same scenario. Same $100,000, same reinvestment, same timeline. And after 1 year, it comes to $108,600. After 10 years, $228,730. After 20,
$525,961, and after 30 years, Schwab's International Fund is projected to reach $1,216,036, paying around $29,397 in annual dividend income, or about $2,450 per month. Out of that, $786,094 would come from capital appreciation and $329,942 from reinvested dividends. Total value added, $1,116,036. Fidelity finishes ahead by $481,937, and this time, both factors are working in Fidelity's favor. A higher starting dividend yield, 3.05% versus Schwab's 2.46%, combined with stronger dividend growth at 6.85% versus 6.37%. When you're reinvesting every payout for 3 decades, those differences stack up fast. This round also goes to Fidelity. So after 5 head-to-head rounds, here's where we stand. Fidelity wins on fees, total market, bonds, and international. Schwab takes the S&P 500. Final scoreboard, Fidelity 4, Schwab 1. But the scoreboard really only tells part of the story. The dollar figures tell the rest. In the S&P 500, Schwab's SWPPX beat Fidelity's FXAIX by $116,154 over 30 years. That's Schwab's only win, and it's a real one. The dividend growth rate on SWPPX compounds into a meaningful gap over 3 decades. But Fidelity pushed back hard across every other category. In the total market round, FZROX finished $1,046,474 ahead of SWTSX, driven by stronger share price appreciation at 13.43% versus 12.57%. In bonds, FXNAX cleared SWAGX by $148,009. Not a blowout, but a clean and consistent edge built on superior dividend growth. And in international markets, FSPSX added $481,937 more than SWISX over the same 30-year window. Fidelity's combined average across its 4 winning categories totals $1,676,420. Subtract Schwab's $116,154 edge in the S&P 500, and Fidelity comes out ahead by over $1.5 million overall. That's why the final winner in this matchup is Fidelity. The fee advantage is structural. The total market gap is over $1 million on its own. The bond and international margins confirm the pattern. When everything is added together, Fidelity's funds leave John with a larger portfolio after 30 years by over $1.5 million. Every week, we spend $20 without even thinking about it. And every week, most tell themselves that amount isn't worth investing. What if I tell you that same $20 a week could eventually pay you over $4,800 a month? In this video, I'll show you exactly how that happens. We'll start with what this money is really meant to do, then walk through how dividend income grows, how reinvesting those payouts compounds over time, and why $20 a week is enough to change the outcome. And in the end, I'll show you a portfolio that can potentially turn $20 a week into over $800,000 and pays more than $4,800 a month in dividends. But before choosing investments, you need to know what the money's meant to do in real life. Growth sounds good, but growth alone doesn't pay bills unless you sell your investments. Income pays the bills. That's why the goal here isn't to beat the market or chase the highest returns. The goal is a steady monthly cash flow. Money that shows up whether the market is up or down. Cash flow reduces the pressure to work. It gives you options. It turns investing into something you can actually use. The target for this video is about $4,800 a month. For many people, that kind of income can cover rent or a mortgage, food, utilities, insurance, and still leave some breathing room. It can replace a paycheck, or at least take pressure off of needing one. But that target doesn't really make sense if you still need hundreds or thousands or even millions of dollars just to get started. The whole idea here is to start small on purpose. That's why this starts with just $20 a week. For most people, that's easy to handle. It doesn't change how you live, and it's small enough to stay consistent, which is what actually drives results. With a small weekly amount like this, the strategy has to be simple. It has to work without big bets, perfect timing, or selling later just to make it useful. The money needs to start doing its job while you're still building. That's why dividends fit so well here. Dividend income only sounds complicated until you look at what's really happening. When you buy a dividend-paying stock, you're buying a small piece of a real business. When that business makes money, part of those profits gets paid out to the owners. That payout is the dividend. It's not extra, it's money the business already earned. That brings it down to one simple question. How much income does it actually produce? That's where dividend yield comes in. Yield is simply the income you receive compared to what you paid for the stock. In general, a yield somewhere around 3% to 5% is a solid range for long-term investing. It's high enough to produce real income, but not so high that it puts the business under stress. Yields that look unusually high often come with risk because they can be a sign the payout won't last. But yield alone isn't enough. What really matters over time is whether those payments grow. Dividend growth shows how fast the income increases year after year. A growth rate in the range of 6% and above is strong for long-term income. At that pace, a dividend that feels small at the start can double over time without you adding more money. There's also share price growth. As strong businesses earn more, their value tends to rise. Annual price growth, somewhere in the mid-single digits to double digits, is healthy over long periods. This doesn't just make the portfolio look better, it supports future dividend increases by keeping the business strong and competitive. The real power shows up when all three of those work together. Yield puts income in your hands today, dividend growth increases that income over time, and price growth supports both by strengthening the business underneath. There's one more thing that really supercharges this kind of portfolio, and it's something most people overlook. It's called DRIP, short for Dividend Reinvestment Plan. This is where dividend investing starts to feel different. With DRIP, instead of taking your dividend payments as cash, you use them to buy more shares of the same investment automatically. A simple example makes this easier to see. Say you own a stock priced at $20 per share and you've built up 100 shares. The company pays a dividend of $2 per share each year. So at the end of the first year, you receive $200 in dividends. With DRIP turned on, that $200 is used to buy more shares. At $20 per share, you buy 10 additional shares. Now, instead of 100, you own 110 shares. In the second year, those extra shares start working with you. With 110 shares paying $2 each, you receive $220 in dividends. That $220 gets reinvested again, buying 11 more shares. Now your total climbs to 121 shares. By the third year, the effect is clear. Those 121 shares now pay $242 in dividends. Reinvested, that buys a little over 12 more shares. Without adding any new money, you've grown from 100 shares to more than 133 shares in just 3 years. That's the compounding effect in action. The income grows because the share count grows, and the share count grows because the income keeps getting reinvested. Each dividend payment increases the next one, simply by being put back to work. Early on, the changes feel small, but they don't stop. Ownership grows, dividends grow, and each cycle feeds into the next. DRIP also removes emotion from the process. You don't decide when to buy. Dividends are reinvested whether prices are higher or lower. So when prices dip, your dividends can buy more shares. When prices rise, the shares you already own are worth more and you benefit from share price growth. Now, in a couple of minutes, I'm going to show you the stocks for a portfolio that make this work faster. And in the end, I'll show you how that portfolio can potentially turn $20 a week into over $800,000 and pay more than $4,800 a month in dividends. On its own, DRIP steadily increases ownership. When you pair it with regular contributions like adding $20 a week, the compounding accelerates even faster. Reinvested dividends grow the base, and new money keeps the cycle moving. But none of this works if the stocks themselves can't support it. DRIP is simple, but it only works when the businesses behind it can keep paying and growing dividends for a long time. That's where stock selection matters. For this portfolio, I focus on 4 categories of dividend stocks. Each category serves a specific purpose in long-term compounding. The first category is blue-chip dividend stocks. These are established companies with long operating histories, strong brands, and steady cash flow. They sell products or services that people continue to use in any economic environment. That consistency supports reliable dividends and makes these stocks the foundation of the portfolio. The second category is dividend aristocrats. These are companies that have increased their dividends every year for at least 25 consecutive years through good markets and bad ones. That kind of track record shows discipline, growing profits, and a real commitment to paying shareholders. These stocks help keep income steady and protect purchasing power over time. The third category is high-yield dividend stocks. These provide more income earlier in the process, which helps speed up reinvestment. The goal isn't extreme yields, but payouts that are attractive and sustainable. Used carefully, these stocks increase cash flow without putting the whole strategy at risk. And the final category is growth-oriented dividend stocks. These companies may not offer the highest yield today, but they consistently grow earnings and dividends. Over time, dividend increases compound into meaningful income. These stocks drive future income growth rather than immediate payouts. When a stock fits at least 3 of these 4 categories, it becomes a strong fit for a DRIP-based portfolio. It means the company can pay income now, grow that income over time, and stay solid enough to keep doing it for years. Using that framework, this portfolio is built around 5 core holdings, each with a clear role. SCHD acts as the anchor. It gives broad exposure to high-quality dividend-paying companies and keeps the portfolio steady. It comes with a 3.59% dividend yield, 10.61% dividend growth over the past decade, and 9.23% annual share price appreciation. This sets a stable base that everything else can build on. PepsiCo adds predictable long-term consistency. As a dividend aristocrat, it brings consumer strength and steady cash flow. It pays a 3.94% dividend yield and has delivered 7.36% dividend growth and shows 5.37% annual share price appreciation. It's not flashy, but it does its job year after year. Federal Agricultural Mortgage Corporation brings the growth engine. The dividend yield sits at 3.41%, but what really stands out is the 25.08% dividend growth rate and 20.11% annual share price appreciation. That growth is driven by agricultural lending and long-term demand for food production, which helps push the portfolio's income higher over time. Merck adds defensive healthcare income. Demand stays steady regardless of economic conditions, which helps stabilize the portfolio. It offers a 3.11% dividend yield, 6.63% dividend growth, and 8.44% annual share price appreciation, providing balance when markets get rough. Nexstar Media Group rounds out the portfolio with strong cash generation and aggressive dividend growth. It delivers a 3.39% dividend yield, 25.62% dividend growth, and 16.56% annual share price appreciation, combining income today with faster income growth for the future. The next step is to calculate the portfolio's overall dividend yield. To keep this easy to follow, we're assuming the portfolio is invested with equal weight in each stock. Start by listing the dividend yield of each holding. SCHD pays a 3.59% yield, PepsiCo is at 3.94%, AGM sits at 3.41%, Merck pays 3.11%, and Nexstar comes in at 3.39%. Since each stock is weighted the same, all you do is add those 5 yields together. The total comes out to 17.44%. Then you divide that number by 5 because there are 5 holdings in the portfolio. That gives you a portfolio dividend yield of 3.49%. This means that, on average, the portfolio pays about 3.49% in annual dividend income based on its total value. You can use this same approach to calculate the other portfolio metrics as well. Using the same simple average, this portfolio comes out to 15.06% dividend growth and 11.94% average annual share price appreciation. Each holding fits multiple categories, which reduces reliance on any single stock. Together, they strike a balance between stability, income, and growth. So let's see what this portfolio can actually turn into when you add $20 a week and let it run over the long term. In the first year, adding $20 a week over 52 weeks means you would have invested $1,040 into this portfolio. This sets the base for future growth. After 10 years, the portfolio is projected to be valued at around $22,334. At that stage, most of the growth would still be coming from the money added each week, with compounding just beginning to show up. Looking further out, after 20 years, the portfolio is projected to reach about $135,192. By then, dividends would be large enough to noticeably accelerate growth. The income itself starts doing more of the work. Finally, by year 30, projections show the portfolio growing to roughly $820,726. At that point, income becomes the main feature. Annual dividends are projected at about $57,830, which works out to roughly $4,819 per month without selling any shares. Over the full 30-year period, the total value added to the portfolio is projected to be about $789,526. Of that, roughly $487,472 would come from capital appreciation, and about $302,054 would come from reinvested dividends. Imagine waking up to a life where your money works for you, where the clink of coins in your pocket is replaced by the notifications of dividends hitting your account. A world where financial freedom isn't just an idea, but something real you can plan around. This isn't some far-off dream, it's something you can actually build toward. Just like living comfortably means different things to different people, there are many financial paths to consider. Some people think about downsizing, selling assets, or moving somewhere cheaper, but there's another option that often gets overlooked: living on investment dividends. A system that can pay you around $4,000 a month without relying on a paycheck. Stick around because we're going to walk through 3 different ways to reach that goal. So how do you figure out how much you really need? It comes down to the life you want to live and the numbers behind it. Averages don't tell the full story. What matters is what feels realistic for you, your expenses, and how much risk you're comfortable taking. This journey is about balance, balancing risk, time, and income. In this video, I'll show you and John how to reach $4,000 a month or $48,000 a year using 3 different dividend income paths. We'll start with the safest option that takes the longest to get there, move into a moderate risk path that shortens the timeline, and finish with the most aggressive approach, the one that reaches the goal in the least amount of time. But before we go any further, let's slow things down and understand what a dividend actually is and how it works. Let's keep this simple because dividends sound more complicated than they actually are. When you buy a stock, you're buying a small piece of a business, not a coupon, not a lottery ticket, a piece of a real company that sells real products and makes real money. When that company earns more than it needs to run the business, it has two choices. It can put that money back into growth, or it can share some of it with the owners. If it chooses to share, that payment is a dividend. If John owns shares in a company that pays dividends, he receives a portion of those profits in cash. The amount depends on how many shares he owns and how much the company pays per share. If the company increases its dividend over time, John's income increases as well, even if he never adds more money. Companies don't all pay on the same schedule. Many pay every 3 months. Some pay monthly. The schedule matters less than whether the business can keep generating profits consistently. This is where dividend yield comes in. Dividend yield tells you how much income an investment produces relative to its price. If a stock costs $100 and pays $10 per year in dividends, the yield is 10%. That yield changes over time. Prices move, dividends can increase or decrease, but yield gives you a clear way to compare income potential across different investments. Lower yields often come with stronger price growth. Higher yields generate more income up front, but may grow more slowly or carry more risk. This trade-off is the entire foundation of dividend investing. You're deciding how much income you want now, how much you want later, and how much volatility you're willing to accept along the way. Dividend yield is the tool that makes this measurable. It lets John compare options in real numbers and see how much capital each one needs to reach that $4,000 a month goal. Not hypothetically, but based on income produced per dollar invested. So now that the foundation is clear, it's time to see how this comes together in the real world. There isn't one perfect dividend investment that does everything well. Some assets grow slowly but safely. Others generate higher income, but move less in price. And some are built purely to maximize cash flow. Trying to reach $4,000 a month with just one of these usually means giving something up, either speed, stability, or flexibility. On the low-risk end are dividend aristocrats, built around consistency and long-term growth. In the middle sit REITs, real estate investment trusts, which trade some stability for higher income. On the high-risk side, which I'll show you in the end, is a portfolio designed to maximize cash flow first, even if price growth takes a back seat. Let's start with the most stable strategy in this entire plan, the Dividend Aristocrats portfolio. This approach is built for people who want reliability first and growth second. Dividend Aristocrats are companies that have increased their dividend payments every single year for at least 25 years. That long track record tells us these businesses can survive recessions, market crashes, and economic slowdowns while still paying their shareholders. In this portfolio, John invests in 3 high-quality Dividend Aristocrat-style holdings that work together. The first is Lowe's Companies Incorporated. Lowe's currently pays a dividend yield of 1.73%. That yield may look modest, but the real strength comes from growth. Over the past 10 years, Lowe's has increased its dividend at a compound annual growth rate of 16.07%, while its share price has appreciated at an average annual rate of 14.73%. This means both income and portfolio value have been compounding strongly over time. Next is NextEra Energy, which adds stability through utilities and clean energy. NextEra pays a dividend yield of 2.67%, with a 10-year dividend growth rate of 11.4%. Its share price appreciation has averaged 12.28% per year, giving the portfolio steady growth along with dependable income. The third holding is Schwab U.S. Dividend Equity ETF, SCHD. This ETF spreads John's investment across dozens of established dividend-paying companies in different industries. SCHD offers a dividend yield of 3.6%, a 10-year dividend growth rate of 10.61%, and annual share price appreciation of 9.04%. This diversification helps reduce risk while keeping income consistent. When all three holdings are combined, the portfolio produces an average dividend yield of 2.67%, with dividend growth of 12.69% per year and average share price appreciation of 12.02%. This makes it a slow but very dependable engine for long-term wealth and income. Now, if you want to get paid $4,000 per month starting in year one from this portfolio, the math is straightforward. At a 2.67% yield, you'd need about $1,798,500 invested up front, roughly $1.8 million to produce $48,000 per year in dividends right away. Let's be honest, most people don't have that kind of capital just laying around. So instead of trying to force income on day one, the projection uses a more realistic setup. John starts with $20,000 and adds $10 per day, which comes out to $3,650 per year. Every dividend is reinvested, so the income keeps compounding on itself. Under these assumptions, the portfolio is projected to reach $26,587 after 1 year. By year 10, it's projected to grow to $152,648. By year 20, it's projected to reach $689,349, and by year 27, the portfolio is projected to reach $1,888,946. At that point, annual dividend income is projected to reach $52,008, or about $4,334 per month, exceeding the $4,000 monthly target without selling assets. Of the $1,770,396 projected to be added to the portfolio over time, $1,410,696 is projected to come from capital appreciation and $359,427 from reinvested dividends. This is why dividend aristocrats sit at the base of the plan. They're built for consistency and long-term growth, not speed. But if the goal is to move the income curve higher earlier, the next step is accepting a bit more volatility in exchange for stronger cash flow. That higher risk profile can help you get to $4,000 per month about 10 years faster, but keep in mind, at the end, I'll show you how an even riskier portfolio can reach the same $4,000 per month target about 17 years faster than the dividend aristocrats. But first, let's look at the medium risk approach, and for that, I have REITs, or real estate investment trusts. REITs are like teams that own real estate instead of one person owning a single building. These teams invest in things like warehouses, office spaces, and advertising properties. They collect rent and income from those properties, and then they share a big part of that money with the people who invest in them. That shared income is paid out as dividends. For John, REITs offer a higher income profile than traditional dividend stocks. In this portfolio, he focuses on 3 REITs that balance income and growth. The first one is Prologis. Prologis owns warehouses and logistics properties that support global supply chains. It pays a dividend yield of 3.18%, and over the last 10 years, its dividends have grown at about 10.27% per year. On top of that, its share price has appreciated by roughly 12.3% annually. Next is CTO Realty Growth. CTO plays a different role in this portfolio. It focuses more on income. CTO pays a much higher dividend yield of 8.41% with a strong 10-year dividend growth rate of 19.14%. Its share price growth has been slower, averaging around 1.71% per year, but the higher income helps boost cash flow. The third REIT is Lamar Advertising. Lamar owns billboards and outdoor advertising spaces across the country. It pays a dividend yield of 5.01%, with dividend growth of about 8.47% and share price appreciation averaging 8.73% per year. This adds another layer of diversification within real estate. When combined, this REIT portfolio produces an average dividend yield of 5.53%. Dividend growth averages 12.63% per year, while share prices grow about 7.58% annually. Compared to dividend aristocrats, this approach generates income sooner with the trade-off of higher sensitivity to economic cycles. Now, if John wanted to get paid $4,000 per month starting in year one from this portfolio, the math works the same way. At a 5.53% yield, generating $48,000 per year would require about $868,000 invested up front to produce that income immediately. That's meaningfully less than the roughly $1.8 million required by dividend aristocrats, but it's still a large sum of capital to put to work all at once. So let's say John invests the same $20,000 and then adds $10 per day with this portfolio. Based on that, this portfolio is projected to reach $26,273 after 1 year. By year 10, it's projected to grow to $152,168. By year 17, it's projected to reach $533,524, and at that point, dividend income is projected to reach $53,829 per year, or about $4,486 per month, crossing the $4,000 monthly target in 17 years. Of the $451,474 projected to be added to the portfolio over time, $193,965 is projected to come from share price growth and $257,509 from reinvested dividends. Many REITs pay dividends monthly, which shortens the gap between owning the asset and receiving income. That higher payout comes from rental cash flow, and it also means the income can fluctuate with property demand and broader economic conditions. This is why REITs sit in the middle of the plan. They reduce the capital required compared to dividend aristocrats and push income higher sooner while still maintaining a growth component. The trade-off is greater sensitivity to economic cycles. So with that in place, it's time to look at the final strategy, the one designed to maximize income speed. One of the quickest paths to living off dividends is by investing in covered call ETFs. These funds are designed for one main purpose: generating income fast. Unlike traditional dividend stocks that rely mostly on company profits, covered call ETFs earn money in two ways: from the stocks they own and from option premiums like covered calls layered on top. A call option gives someone else the right, but not the obligation, to buy those stocks at a set price within a certain time period. In simple words, when the covered call ETF owns a stock, it can agree to sell that stock later at a set price. Someone else pays the ETF money up front for that agreement. The ETF keeps that money no matter what, and that cash is used to pay income to investors. If the stock price stays below that set price, the ETF keeps the stock and the extra money. If the stock price goes above it, the ETF may have to sell the stock, and that limits how much the price can grow, but it allows the ETF to keep paying high income. For John, this tier is about reaching income faster. The portfolio uses 3 covered call ETFs. The first is JP Morgan Nasdaq Equity Premium Income ETF with the ticker JEPQ, which focuses on large technology stocks. JEPQ offers a dividend yield of 10.34%, with dividend growth averaging 16.7% and share price appreciation of about 11.1% per year. Next is the Invesco S&P 500 Buy Right ETF with the ticker PBP. This ETF writes call options on S&P 500 stocks. It pays an even higher dividend yield of 11.2% with strong dividend growth of 22.61%, although its share price appreciation has been slower at around 1.65% per year. The third fund is the Global X S&P 500 Covered Call ETF with the ticker XYLD. It pays a dividend yield of 10.48% with dividend growth of 6.94% and very limited share price appreciation of about 0.15% per year. When these three ETFs are combined, the portfolio produces an average dividend yield of 10.67%. Dividend growth averages 15.42%, while share price appreciation averages 4.3%. Income grows much faster here, but price growth is more limited, which sets up how quickly this strategy can move toward the $4,000 per month goal. So here we go. Let's apply this strategy to John's goal. John wants to earn $4,000 per month or $48,000 per year. With an average yield of 10.67%, generating that income immediately would require roughly $450,000 invested up front. That amount is far lower than what Dividend aristocrats or REITs would require, which is why this strategy shortens the timeline so much. But how does it perform when John invests $20,000 and $10 a day into this portfolio? Under these assumptions, the portfolio is projected to reach $26,645 after 1 year. By the 5-year mark, the portfolio would be around $71,579, and by year 10, it's projected to grow to $267,217. At that point, dividend income is projected to reach $55,091 per year, or about $4,591 per month, crossing that $4,000 monthly target in just 10 years. Of the $210,717 projected to be added to the portfolio over time, $34,991 is projected to come from capital appreciation and $175,726 from reinvested dividends. So, covered call ETFs turn capital into income faster than any other approaches. The trade-off is that price growth is limited, especially during strong bull markets. That's why this strategy works best after a foundation is already in place, when the goal shifts from growing capital to pulling income from it. When you line the three strategies up by time, the difference becomes obvious. Dividend aristocrats take the longest, reaching the $4,000 per month target in about 27 years. That long runway comes from lower yield, but it also brings the most stability and long-term growth. REITs shorten that timeline to about 17 years. That's roughly 10 years faster than dividend aristocrats, driven by higher income and steady growth, with more exposure to economic cycles. Covered call ETFs compress the timeline even further, reaching the same $4,000 per month goal in about 10 years. That's about 7 years faster than REITs and roughly 17 years faster than dividend aristocrats, made possible by much higher yields and faster cash flow. All three paths reach the same income goal. The difference is how long it takes and what you give up along the way to get there. A lot of people do everything right with their Roth IRA. They contribute, they pick solid ETFs, they stay consistent, and yet the account still feels underwhelming. Not broken, just unclear. You add another ETF, you make a small tweak, you assume it'll all come together over time, but there's usually a question in the background. Is this actually set up the right way? Or am I overcomplicating something that's supposed to be simple? Because when an account that powerful feels stressful or confusing, it's rarely about effort. It's almost always about structure. In this video, I'm going to break down 5 ETFs that can truly supercharge your Roth IRA in 2026. Not as a random top 5 list, but as a clean, intentional portfolio where every ETF has a clear job and nothing fights against you. I'll show you how these pieces work together, why this setup is often better than what most people already have, and how it can make your Roth IRA feel simpler and easier to stick with. And at the end, I'll show you how a tax-free Roth IRA built with this exact portfolio can turn a simple $100,000 weekly contribution into a $1 million plus account that generates over $2,000 a month in dividend income. To understand why that works, you need to know what a Roth IRA actually is. A Roth IRA is a retirement account where you invest money after you've already paid taxes on it. That detail matters more than anything else. Because taxes are paid up front, everything that happens inside the account grows tax-free. That means price growth is never taxed. Dividends are not taxed while they're reinvested. And when the money is taken out in retirement, it comes out tax-free as well. No yearly tax bill, no capital gains tax, no tax on income. This makes a Roth IRA very different from a taxable account or a traditional retirement account. In those accounts, taxes reduce growth along the way. In a Roth IRA, nothing gets taken out as the account grows. Because of that, the account rewards long-term thinking more than short-term moves. The biggest benefit comes from staying invested, reinvesting income, and letting compounding work over many years without interruption. That tax-free setup also means mistakes show up faster. Poor structure, too many decisions, or constant changes can work against compounding just as quickly as a good structure can help it. That's where many people run into trouble. A big reason a Roth IRA feels harder than it should is that most people don't actually change how they think when they open one. They treat it like any other investment account. Same mindset, same habits, same kind of decisions. But a Roth isn't just another place to hold investments. It plays by different rules. And when you ignore those rules, things start to feel messy fast. One big problem is overlap. It's easy to keep adding ETFs because each one sounds useful, but over time, the portfolio grows in size, but not in purpose. Several funds end up doing the same job just in different packages. That adds complexity without real benefit. And when markets move, that complexity makes it harder to feel confident. Another issue is chasing a single idea. Some people focus almost entirely on growth, assuming they'll deal with income later. Others swing the opposite way and prioritize dividends early, even if growth gets sacrificed. Inside a Roth, both of those approaches miss the point. Growth and income aren't competing goals here. They're supposed to support each other through reinvestment. There's also the emotional side that rarely gets talked about. When an account is built around price movement alone, every downturn feels personal. That's when people start checking balances more often, making small adjustments, and convincing themselves they're being proactive. All of this makes the Roth IRA feel like it requires constant attention to work properly. But that's not because the account is complex, it's because the structure asks the investor to do too much. The more decisions you have to make, the easier it is to doubt yourself and second-guess every move. Most of that difficulty comes from unnecessary complexity. Too many funds, too many ideas, too much focus on small details that don't matter much over the long run. A Roth IRA doesn't benefit from that. It works better with fewer pieces and clearer roles. When each part has a purpose, the account becomes easier to manage and easier to trust. That shift in thinking changes how the entire account feels. A Roth IRA becomes easier to understand when you stop trying to optimize everything at the same time. Many people search for the best performing ETF, the highest dividend, the best sector, and the perfect timing. That effort feels productive, but inside a Roth, it usually does the opposite. A simpler way to think about money inside a Roth is to stop evaluating investments by how impressive they look on their own and start thinking about what role they play together. Every dollar you contribute only needs to do a few things over a long period of time. It needs to grow. It needs to generate cash that can be reinvested. It needs to stay invested through good markets and bad ones. And it needs to do all of that without forcing you to constantly step in and make decisions. When you think this way, a lot of common investing questions stop being useful. It matters less whether one ETF slightly outperforms another in a given year. What matters more is whether each piece of the portfolio is doing a different job. Growth assets push the account forward over decades. Income-producing assets smooth the ride and add more shares when prices are down. Stabilizing assets reduce the chance that you abandon the plan at the worst possible time. This is why fewer ETFs, chosen intentionally, often outperform more complicated portfolios in real life. Not because they earn higher returns on paper, but because they make it easier to stay consistent. Consistency is the real advantage inside a Roth. With taxes out of the way, time and reinvestment do most of the work. Once you see money inside a Roth IRA this way, the portfolio almost builds itself. You're no longer searching for clever ideas, you're simply looking for a small set of tools that cover clear roles and don't overlap too much with each other. From there, the question isn't what to add next, but whether each piece earns its place. That mindset naturally leads to a simple, balanced structure where every ETF exists for a reason. Growth inside a Roth IRA isn't about being clever. It's about giving the account a strong engine that can do most of the work over time. That role is filled by a broad market fund like the Vanguard Total Stock Market ETF. VTI represents the entire U.S. stock market in a single fund. Large companies, mid-sized companies, small companies, all moving together. There's no need to guess which sector will perform best next year or rotate between trends. The portfolio simply grows with the U.S. economy over the long run. Historically, that growth has been powerful. Over the last 10 years, VTI's share price has increased by roughly 245%, meaning $1 grew into more than $3 before dividends. That long-term growth is the reason it sits at the center of this portfolio. The fund also pays a dividend with a current yield of about 1.1%, and that payout has grown at roughly 6% per year on average, adding another layer of compounding over time. Because this fund is the main foundation and growth driver, it carries more responsibility than any other position. That's why in this portfolio, it's given 30% of the total allocation. It's enough to drive long-term growth, but not so much that the entire outcome depends on market prices alone. Relying only on growth creates another issue that shows up during market pullbacks. Even when the math still works, a growth-heavy portfolio can feel unstable. That emotional pressure makes it harder to stay invested when prices fall. That's where support becomes important. Growth sets the direction, but it works best when paired with income. Cash keeps flowing even when markets are down, which helps smooth the experience and makes it easier to stick with the plan. So the next problem to solve is how to add income without slowing long-term compounding. Income inside a Roth IRA works best when it supports growth instead of competing with it. Dividends aren't meant to be spent here, they're meant to be reinvested, especially during periods when prices are lower. That's the role filled by Schwab US Dividend Equity ETF. SCHD focuses on high-quality U.S. companies with long histories of paying dividends and raising them. The current dividend yield is about 3.6%, which is much higher than the broad market. More importantly, those dividends have grown at roughly 10% per year on average. That steady growth matters because rising cash flow buys more shares over time without needing prices to move higher. Because this fund provides reliable income and strong dividend growth, it plays a stabilizing role in the portfolio. That's why in this portfolio, it's also given 30% of the allocation. The goal isn't to chase yield, but to create a steady stream of reinvestment that keeps working in both strong and weaker markets. When markets are doing well, SCHD's income compounds alongside growth. When markets struggle, that same income keeps buying shares in the background. Instead of reacting to price swings, the portfolio continues building ownership automatically. Many investors get dividends wrong by focusing only on yield. High yield without growth often leads to disappointment. SCHD works differently. The combination of a solid yield and fast-growing payouts turns income into long-term growth, especially inside a tax-free account. Paired with a growth fund like VTI, SCHD smooths the overall experience. Growth pushes the account forward, while income reduces emotional pressure during downturns. The portfolio becomes easier to hold through market stress. The next gap to address is diversification beyond the U.S., since relying on one economy still leaves the portfolio exposed to a single outcome. After that, I'll show you 2 more ETFs for this portfolio, and at the end, I'll show you how a tax-free Roth IRA built with this exact setup can turn a simple $100 weekly contribution into a $1 million plus account that generates over $2,000 a month in dividend income. But first, let's look at the third ETF, which adds diversification beyond the U.S. A portfolio built only around U.S. companies stays tied to one economy, one currency, and one set of market cycles. That can work for long stretches, but over decades, it creates concentration risk. Global exposure reduces that risk by spreading growth and income across different parts of the world. That's the role filled by the Vanguard Total International Stock ETF. VXUS holds thousands of companies across developed and emerging markets. Different regions grow at different speeds, pay dividends differently, and move through economic cycles on their own timelines. This doesn't make the portfolio more exciting, but it does make it more balanced. The account no longer depends entirely on how the U.S. performs. One of the most overlooked features of VXUS is income. International stocks tend to pay higher dividends on average, and VXUS reflects that with a yield of about 3.1%, and those dividends have grown at roughly 13% per year on average. That creates a second stream of reinvestment that behaves differently from U.S. dividends, which adds balance instead of overlap. Price appreciation for international stocks has historically been lower, averaging around 7%, and is less consistent than the U.S. market, and that often turns investors away. Inside a Roth IRA, that trade-off looks different. You're not trying to beat U.S. stocks year to year. The goal is to reduce reliance on a single country while allowing reinvestment and time to do the work. Because VXUS adds diversification without dominating the portfolio, it's given a smaller role than U.S. holdings, but still large enough to matter. In this portfolio, it's allocated 20%. That amount broadens growth and income sources without competing with the core U.S. strategy. So with global exposure added, the portfolio becomes more balanced across economies. But everything so far is still built on stocks, which means market swings are still part of the experience. The next problem to solve is how to add stability using assets that behave differently from stocks altogether. So stocks represent businesses, but they don't represent physical assets. Real estate fills that gap. It ties part of the portfolio to buildings, rents, and long-term leases instead of company earnings. That's the role played by the Vanguard Real Estate ETF. VNQ owns a broad mix of real estate investment trusts across sectors like residential housing, commercial properties, data centers, and healthcare facilities. These businesses generate income from rents and long-term leases, which tend to adjust over time as prices in the economy rise. That makes real estate a useful complement to stocks. The yield on VNQ is higher than the broad stock market, sitting around 3.7%, but the growth of that income has historically been modest. Price appreciation has been relatively limited compared to equities. Inside a Roth IRA, that combination still serves a clear purpose. VNQ isn't meant to drive growth. It exists to add a real asset income source that doesn't move in sync with stocks. Because real estate adds diversification but also brings volatility of its own, it plays a smaller role in the portfolio. In this setup, VNQ is given 10% of the allocation. That amount is enough to add real asset exposure and income without letting real estate swings control the overall outcome. Real estate here is not about speed or excitement. It's about balance. During periods of higher inflation or uneven stock performance, rental income provides another source of return that doesn't depend on stock prices rising. So now with growth, income, global exposure, and real assets now included, the portfolio covers most major risks. One vulnerability still remains, however. Even diversified portfolios can swing sharply during market stress. Solving that problem requires an asset focused on stability rather than returns. And that is where bonds come in. Bonds are often misunderstood. Many people assume adding bonds means giving up returns. That happens when bonds are judged the same way as stocks. In this portfolio, bonds serve a different purpose. They exist to keep the rest of the strategy working during difficult markets. And that role is filled by the Vanguard Total Bond Market ETF. BND holds a broad mix of U.S. government and high-quality corporate bonds across different maturities. It's not designed to be exciting, and that's exactly the point. Bonds tend to move differently from stocks, especially during periods of stress. When equity markets drop sharply, bonds often hold their value better or decline less, which gives the portfolio a stabilizing anchor. The yield on BND has become more meaningful in recent years, sitting around 3.8%. Growth is modest, and there will be years when returns are flat or even slightly negative. Inside a Roth IRA, that's totally acceptable. BND's job isn't to push the portfolio forward, it's to reduce volatility and protect consistency so the rest of the strategy can keep compounding. Because stability is important but shouldn't overpower growth, bonds play a smaller role here. In this portfolio, BND is given 10% of the allocation. That amount is enough to reduce volatility without slowing the long-term plan. Stability matters more than it looks on paper. Large swings increase the chances of panic, hesitation, or stopping contributions entirely. Bonds reduce those risks by making the experience more predictable, which helps investors stay consistent. So now with bonds included, every major role inside the Roth IRA is covered. Growth pushes the account forward. Income adds shares through reinvestment. Global exposure spreads risk across economies. Real assets diversify cash flow. Bonds protect consistency. When all 5 ETFs are combined, the portfolio takes on clear, measurable traits. The average dividend yield is about 2.8%, which creates income early and supports reinvestment. That income grows at roughly 8% per year, increasing the number of shares owned over time. On the growth side, the blended long-term price appreciation is about 8.4% per year. Growth comes from U.S. stocks, diversification from international stocks, income from dividends and real estate, and stability from bonds. No single ETF controls the result. This balance reduces large swings and lowers the need for changes. Growth pushes the account forward. Income adds shares, and stabilizers reduce volatility. With taxes removed and reinvestment automatic, consistency matters more than timing. The structure is designed to compound with minimal decisions. So now, let's look what this portfolio is projected to deliver over the long run. The projections are based on a steady contribution of $100 per week. They assume dividend reinvestment, long-term price growth based on historical averages, and no changes to the portfolio structure. After the first year, projected contributions total $5,200. At this stage, the portfolio is still small and growth is limited. But after 10 years, projections show the portfolio valued at approximately $87,700. Contributions still play a large role, but compounding starts to matter. After 20 years, the projected portfolio value increases to about $339,000. At this point, reinvestment and price growth account for most of the increase, not new contributions. And finally, after 30 years, projections show the portfolio valued at roughly $1.05 million. Of that total value, about $685,000 comes from capital appreciation driven by price growth, and about $213,000 comes from dividends that were reinvested over time. Together, those two sources account for roughly $898,000 in value added beyond contributions. At that level, projected annual dividend income reaches about $24,000, fully tax-free. That equals roughly $2,000 per month without selling shares or changing the portfolio. John has $1 million. He wants to buy $1 million house and pay for it in cash, but there's a problem. If he buys the house today, his account goes to zero. John doesn't want that. Nobody wants that. So he starts asking a different question. Instead of asking, can he buy the house, he asks, how fast can he double this $1 million using ETFs? Because if he can turn it into $2 million, he gets to keep the house and still keeps $1 million in his account. So now the entire problem comes down to one thing. How fast can that actually happen? In this video, we're breaking that question down step by step. We'll look at how different ETFs grow money at different speeds, starting with the most familiar conservative option and moving toward the fastest, most aggressive one. For each ETF, we'll walk through what it holds, how it grows, and how the projected value of John's $1 million changes year by year until the moment a second million finally shows up. And in the end, I'll show you which ETFs take that timeline from about 6 years down to as little as 2 years so John can buy the $1 million house in cash and still have $1 million left in his account. To see how that timeline gets compressed, John starts with the most familiar option first, the one many investors already use as their baseline, which brings him to the Vanguard S&P 500 ETF, ticker VOO. This fund tracks the 500 largest publicly traded companies in the United States. It's weighted by market value, which means the companies that perform the best naturally become a bigger part of the fund over time. There's no manager making bets and no attempt to time the market. It simply owns the dominant businesses that already drive the U.S. economy. VOO is built for reliability. It's broadly diversified across sectors. It carries an extremely low expense ratio of 0.03%, and most of its long-term returns have come from steady price appreciation rather than income. Dividends exist, but they're not the main driver. Looking at the last 10 years, the chart shows VOO is up roughly 269% in total. Spread across that decade, that averages out to about 12.61% per year. That historical growth rate is what sets expectations before projecting anything forward. Based on that pace, John starts running the numbers on what VOO could realistically do for him. If he places his $1 million into the fund, projections show the portfolio valued at around $1,137,200 after year one. In year two, as compounding continues to stack, the projected balance moves up to roughly $1,292,395. By year three, John's looking at a projected value near $1,467,888, and by year four, around $1,666,277. As John keeps pushing the timeline forward, the compounding becomes harder to ignore. By year 5, projections place the portfolio at approximately $1,890,488. Then, in year 6, the moment he's been waiting for finally shows up. The account is projected to be valued at about $2,143,818. At that point, the second million is hit. John can buy the $1 million house in cash, and his original $1 million remains invested. For John, that 6-year wait becomes the trade-off. VOO offers stability, broad exposure, and patience, but not speed. So once he sees how long it takes, even when owning the biggest companies in the market, the next question becomes unavoidable. If this is the timeline when he sticks with market leaders, what happens when growth itself becomes the priority instead? That question is what leads John to the next option on his list, the Vanguard Growth Index Fund ETF, ticker VUG. This fund is built by filtering the U.S. market down to companies expected to grow faster than average. Instead of trying to own everything, it leans into businesses that are reinvesting heavily, expanding revenues, and pushing earnings growth harder than the broader market. VUG still holds hundreds of companies, but the mix looks very different compared to VOO. Slower-growing sectors get less weight, while technology, communication, and growth-oriented businesses take the lead. Looking at the last 10 years, the chart shows VUG is up roughly 402% in total. Spread across that decade, that averages out to about 15.31% per year. That higher growth rate is the trade John is making before looking at the projections. Based on that pace, John starts mapping out what VUG could realistically do for him. Projections show that by year 1, the portfolio would be valued at around $1,157,300. In year 2, continued growth pushes the projected balance to roughly $1,338,782. By year 3, John is looking at a projected value near $1,548,150, and by year 4, around $1,789,673. The difference shows up quickly. By year 5, projections place the portfolio at approximately $2,068,274. At that point, the second million milestone is hit, and John can buy the $1 million house in cash, and his original million remains invested. That 1-year difference comes from prioritizing growth over balance. VUG proves that simply leaning into faster-growing companies can pull the timeline forward without changing anything else. But John isn't done asking questions. If growth alone can shave off a full year, he wants to know what happens when growth stops being broad and starts becoming focused. That question pushes him towards the Vanguard Information Technology Index Fund ETF, ticker VGT. VGT narrows its focus almost entirely to technology and innovation-driven companies. Software platforms, semiconductor designers, hardware manufacturers, and digital infrastructure providers make up the core of the portfolio. These are businesses that can scale quickly, expand margins, and grow earnings without costs rising at the same pace. Unlike the previous ETFs, VGT is not trying to represent the whole economy. It's deliberately leaning into one sector that has reshaped how people work, communicate, and spend money. Nearly all of the return comes from price appreciation. The expense ratio stays relatively low, but the trade-off is concentration. When technology leads the market, this fund moves fast. When it struggles, the swings are much larger. Looking at the last 10 years, the chart shows VGT is up roughly 676% in total. Spread across that decade, that averages out to about 22.03% per year. That kind of growth is what pulls the timeline forward so aggressively. Using that growth rate, John runs the numbers on what this could look like over time. Year 1 puts the portfolio at a projected value of around $1,224,400. By year 2, compounding lifts the balance to roughly $1,498,138. By year 3, the projection shows the account nearing $1,832,082. Then the timeline finally breaks open. By year 4, projections place the portfolio at approximately $2,239,497. So at year 4, John can buy the $1 million house in cash, and his original $1 million remains invested. Cutting the wait down to 4 years comes from committing fully to a sector built for scalability. That decision answers one question for John, but it immediately creates another. If focusing on technology can move the timeline this much, what happens when he stops spreading across the entire sector and narrows in on the part that actually powers it? We'll see that next. And in the end, I'll show you an ETF that takes that timeline from about 4 years down to as little as 2 years, so John can buy the $1 million house in cash and still have $1 million left in his account. But first, let's look at a specific part of the sector. The iShares Semiconductor ETF, ticker SOXX. Here, the focus tightens again. Instead of owning all of technology, SOXX concentrates on a single layer underneath it: semiconductors. These are the companies designing and manufacturing the chips that run data centers, smartphones, artificial intelligence systems, and nearly every modern device. Without them, none of the software, platforms, or digital services would exist. SOXX is built around a much smaller group of companies compared to the previous ETFs. That concentration is intentional. When demand for computing power rises, chip makers often see explosive revenue growth, but the reverse is also true. This industry is highly cyclical, which means periods of rapid expansion can be followed by sharp slowdowns. Dividends play almost no role here. Returns are driven nearly entirely by price movement. Looking at the last 10 years, the chart shows SOXX is up roughly 1,208% in total. Spread that across the decade, that averages out to about 28.69% per year. Based on that pace, projections show that if John invests his $1 million into SOXX, the acceleration is immediate. By year 1, the portfolio is projected to be valued at around $1,291,888. In year 2, continued compounding pushes the projected balance to roughly $1,668,165. Then the shift becomes undeniable. By year 3, projections place the portfolio at approximately $2,153,124, placing the house buying target within reach in just 3 years. Getting there in roughly 3 years comes from extreme concentration in a single fast-moving industry. And for John, that raises one final question. If concentration alone can compress the timeline this much, what happens when leverage is added on top of growth? That's what leads John to the final option, the ProShares Ultra Pro QQQ ETF, ticker TQQQ. This fund removes the last layer of restraint. TQQQ doesn't simply track growth companies, it uses leverage to magnify the daily movement of the NASDAQ 100. This ETF is designed to move about 3 times as much as the NASDAQ 100 on a daily basis. TQQQ holds the same underlying companies you'd find in a growth-heavy NASDAQ portfolio, but it adds leverage on top. That leverage is reset daily, which makes this ETF behave very differently from everything else John has looked at so far. Gains can stack quickly during strong trends, but the margin for error becomes much smaller. The expense ratio is higher at 0.82%, and volatility is no longer a side effect, it is the defining feature. Looking at the last 10 years, the chart shows TQQQ is up roughly 3,360% in total. Spread across that decade, that averages out to about 41.13% per year. That kind of growth explains why this ETF sits at the extreme end of the speed spectrum. With TQQQ, John doesn't need to wait for compounding to slowly reveal itself. The projections move fast enough that the timeline almost collapses. Within the first year, the portfolio is projected to clear roughly $1,417,600. And before a second full year has even passed, the balance is projected to cross the $2 million mark at around $2,005,916, making it faster than any other fund on the list. That crossing is all that matters. John can buy the $1 million house outright even before the end of the second year while still keeping his original $1 million. When you line the timelines up from longest to shortest, the pattern becomes very clear. The slowest path belongs to VOO, the Vanguard S&P 500 ETF. By prioritizing broad exposure and stability, it doesn't reach the $2 million mark until year 6. Next is VUG, the Vanguard Growth Index Fund ETF. By leaning into faster-growing companies while staying diversified, it shortens the wait and reaches the target in year 5. After that comes VGT, the Vanguard Information Technology Index Fund ETF. By concentrating entirely on the technology sector, it pulls the timeline forward again and crosses the $2 million mark in year 4. Then there's SOXX, the iShares Semiconductor ETF. With extreme concentration in a single fast-moving industry, it compresses the timeline even further and reaches the goal in just year 3. And at the near end of the chart is TQQQ, the ProShares Ultra Pro QQQ ETF. By stacking leverage on top of growth, it cuts the timeline down to its shortest point, hitting $2 million in roughly 2 years, faster than any other option on the list. Look, $1 million is the universal retirement number. And we're going to get there in this video 3 completely different ways. The question is, how much would you actually need to invest every single day to make it happen in just 10 years? Most people guess way off, some way too high, some way too low. The real number is the kind of thing that changes how you think about almost every other financial decision you make. John's about to find that number 3 different ways. In this video, John's going to walk through 3 Fidelity Index Fund portfolios, one built for 30 years, one for 20, and one for 10. All 3 start from $0. All 3 end at the same $1 million finish line. For each portfolio, you'll see the exact funds, how much John puts into each one, and what the balance looks like year by year. And in the end, I'll show you how John reaches $1 million in just 10 years. But before we get to any of those daily numbers, let's start with the destination. Why $1 million, and what does it actually do for John once he gets there? Let's say John has nothing saved for retirement, not a single dollar. He works a regular job, makes a regular income, and until about a week ago, he was pretty sure retirement was something that happened to other people. Then he ran the numbers. The number everyone talks about is $1 million, and there's a reason for that. There's a retirement strategy called the 4% rule, backed by decades of research. The idea is simple. If John's got $1 million invested in an index fund portfolio, he can pull out 4% of it in his first year of retirement. That's $40,000, money he didn't have to work for. The next year, he adjusts slightly up for inflation, and he does it again, year after year. The reason this works without draining the account is because the market typically grows faster than 4%. So while John pulls out $40,000 a year to live on, the portfolio is still growing in the background. The principal usually stays intact, and in a lot of cases, the account actually keeps getting bigger while John spends from it. $40,000 a year breaks down to $3,333 going into John's account every single month, whether he works or not. Add the average Social Security check on top of that, about $2,076 a month, and John is looking at over $5,400 a month in retirement income. So $1 million is the destination. The question is how to get there from $0. And the answer depends almost entirely on something John hasn't decided yet: how much time he's willing to give it. And no matter which timeline John picks, the funds he uses are the same. So let's look at the three he's working with. The three funds John uses are all from Fidelity, one you've definitely heard of, one you might have heard of, and one that's about to surprise you. The first is FXAIX, the Fidelity 500 Index Fund. It's the biggest, most boring fund in John's portfolio, and that's exactly why it works. FXAIX tracks the S&P 500, the 500 largest companies in the U.S. So when you buy it, you're basically buying a slice of the American economy. Expense ratio 0.02%, which is about as close to free as investing gets. Over the last 10 years, it's averaged about 12.97% in annual share price appreciation. That's the foundation of every portfolio in this video. The second is FNCMX, the Fidelity NASDAQ Composite Index Fund. This one tilts towards growth. Instead of the S&P 500, it tracks the entire NASDAQ, heavier on tech, biotech, the kind of companies that grow faster but also swing harder. Over the last 10 years, FNCMX has averaged about 16.91% in annual appreciation. Higher reward, higher volatility. The bridge between safe and aggressive. And finally, there's FSELX, the Fidelity Select Semiconductors portfolio. This is the wild card. It only invests in semiconductor companies, the chip makers behind every phone, every laptop, every AI model. Over the last 10 years, FSELX has averaged 22.04% in annual appreciation. That's not a typo. It's also the riskiest fund in this video. Semiconductors are cyclical, which means when they crash hard. But for the right portfolio on the right timeline, FSELX is the engine that makes a 10-year retirement actually possible. Okay, so those are the three funds. Now let's see how John actually uses them. And he's going to start with the easiest version first. John starts with the longest timeline, 30 years. The reason is simple. When you've got that much time on your side, the math does most of the work for you, so the portfolio doesn't need to take much risk. Here's how it breaks down. 60% in FXAIX, 30% in FNCMX, and just 10% in FSELX. The broad market does the heavy lifting. The NASDAQ adds some growth. And the semiconductors are there for a small kick of upside without taking the whole portfolio off course. Blend these three together, and what you get is a portfolio with a 0.81% dividend yield, a 6.18% dividend growth rate, and an annual share price appreciation of just over 15%. The dividend yield isn't huge, but with 30 years to compound, it really doesn't need to be. The 15% appreciation is doing the heavy lifting. So how much does John actually have to invest to make this work? $6 a day. That's it. $6 a day, about the cost of a coffee and a bagel. And here's what happens to that $6 a day. By the end of year one, John's account sits at $2,190, basically what he put in. By year 10, that account is projected to be at $45,641. By year 20, it's $234,158, and by the end of year 30, the day John retires, that account is worth $1,004,150. A little over $1 million from $6 a day. And remember, at $1 million, that account starts paying him $3,333 every single month for the rest of his life if he uses the 4% rule, from a daily contribution, roughly the price of breakfast. But here's the part that matters most. Of the $1,004,150 in John's account, John actually contributed only $65,700 of his own money. The other $938,450 was the market doing what the market does over a long enough timeline. That's the thing about 30 years. You're not really the one building the wealth, you're just the one who showed up consistently. The compounding does all the work as long as you give it the time. But here's the thing. Most people watching this don't actually have 30 years to give. So what happens when you cut compounding's runway by a third? One plan down, two to go. And in the end, I'll show you how John reaches $1 million in just 10 years. But first, let's look at the 20-year portfolio. For this, we use the same three Fidelity funds, FXAIX, FNCMX, and FSELX. But now the weights shift. FXAIX drops from 60% down to 35%. FNCMX moves up to 40%. It's now the largest piece of the portfolio. And FSELX more than doubles from 10% to 25%. The reason is straightforward. With less time on his side, John needs the portfolio to grow faster. So the broad market shrinks and the more aggressive funds take over more of the workload. The new portfolio comes out to a 0.58% blended dividend yield, a 5.16% dividend growth rate, and an annual share price appreciation of about 16.81%. The yield drops, the dividend growth drops, but the appreciation climbs, which is exactly the trade John is making. Now, here's the daily number. $22 a day. Almost 4 times what the 30-year version cost. About $660 a month, $8,030 a year. That's still a doable number for a lot of people watching this. It's a couple of skipped restaurant meals, a smaller car payment, the gym membership, and the streaming subscriptions nobody really uses. But it's a real number. It demands a level of discipline that the 30-year plan doesn't. And here's how it grows. By the end of year 1, John's account is at $8,030. By year 10, it's projected to reach $180,684. And by year 20, exactly 10 years earlier than the first plan, that account hits $1,040,920. Same finish line, same $1 million portfolio. But notice what shifted. In the 30-year version, John contributed $65,700 of his own money. In the 20-year version, he contributed $160,600 of his own money, almost 2.5 times more. The market still does most of the work, but a much bigger share than the last version of that final $1 million came directly out of John's pocket. You bought 10 years of time back, and the price was about $95,000 extra out of your own paycheck. Now we get to the version most people click this video for. The 10-year version, the one the title promised, the one that turns $0 into $1,083,063 in just a decade. And yes, it's going to cost a lot more than $22 a day. But before I show you the math, I need to be honest with you for a second. The 10-year plan is the most aggressive version of this video, and it's not for everyone. Now let me show you the actual math so you can decide for yourself. Here's the portfolio. FXAIX drops all the way down to just 15%. FNCMX sits at 35%. And FSELX, the semiconductor fund, takes the largest position at 50%. Half the portfolio is now in a single sector. That's a concentrated bet on growth. The reason is the same reason that's been true the whole video. With only 10 years to compound, the broad market alone isn't going to get John to $1 million. The portfolio needs to grow at a rate that the broad market just can't deliver inside a decade, so the aggression level doubles. The blended numbers reflect that. The dividend yield drops to 0.34%. The dividend growth rate drops to 3.44%, but the share price appreciation jumps to 18.88%, the highest of all three portfolios. And the daily contribution, brace yourself, $120 a day. $43,800 a year, about $3,650 a month, every month for 10 years straight. To pull that off, you're realistically looking at a household income somewhere around $120,000 a year, because below that, $3,650 a month into investments isn't a realistic ask after rent, groceries, and the rest of life. If that's not where you're at, the 30-year or 20-year plan is the version that best fits you. That's not a downgrade, that's just what math allows. But for the people who can do it, here's what it builds. By the end of year 1, John's account is at $43,800, basically all his own money since the market hasn't had time to do anything yet. By year 5, that account is projected to reach $320,168, with the market now adding meaningfully on top of John's daily contributions. And by the end of year 10, the account is worth $1,083,063. Of that $1,083,063 in John's account, John personally contributed $438,000. The market added $645,063. The market is still doing more of the work here, but barely. John writes a check for almost $500,000. The market still adds more, but the gap is almost gone. He's matching it nearly dollar for dollar. That's the price of cutting compounding's runway down to a decade. You can do it, but you're paying for the time you didn't give it. Now, here's where it gets interesting. 3 plans all landing at the exact same place, but the math behind each one tells a completely different story. Take a look at this side by side. Same destination at the top, $1 million in John's account, no matter which path he picks. But the road that actually matters is the one showing what John personally put in. In the 30-year version, John barely contributes anything, $65,700 over 3 decades, about the price of a new SUV spread across 30 years. The market does almost all of the work for him. Cut the timeline in half, and John's contribution jumps to $160,600. Same destination, but a much bigger chunk of it now coming straight out of his pocket. Now look at the 10-year column. John writes a check for $438,000 over a decade, almost 7 times what the 30-year version cost him. Same finish line. Look at one more thing. For every dollar John puts in himself, the market hands him a different amount back, depending on the timeline. In the 30-year version, the market gives him about $14 for every dollar of his own. In the 20-year version, that shrinks to $5.50 for every dollar. And in the 10-year version, the market only gives him $1.50 per dollar he puts in. That's the trade. That's what this video is really about. Time isn't free, but it's the cheapest source of retirement money there is. The longer you give compounding to do its job, the less of your own paycheck has to fund the destination. The shorter the runway, the more you have to make up for that time out of pocket. John can pick any of these 3 plans. They all land him at the same place. The only question is, which one actually matches what he can live with for as long as it takes?
If this helped you think about money more clearly, stick with the channel. Everything here is built to make long-term investing feel simpler and more realistic.